No safety in treasuries either as yields spike.
More disharmony in the White House. Elon Musk and Peter Navarro's tariff war continues to play out in public, with the Tesla boss calling Trump's top trade advisor, quote, dumber than a sack of bricks. Germany's leading parties reportedly stand on the brink of a coalition deal after marathon talks late into the night.
The U.S. has implemented its harshest tariff regime in over a century, with what the White House calls reciprocal levies coming into effect on countries from Algeria to Zimbabwe just over an hour ago. Futures are selling off both sides of the Atlantic, with investors also spurning treasuries. Yields are notching double-digit basis point surges on the long end of the curve this morning. Meanwhile, the offshore yuan is paring losses after it hit its weakest level on record overnight, as China grapples with 104% levies on goods sold to America. So a lot to unpick here on the yield and currency side. But in the meantime, speaking last night, President Trump was defiant on the issue.
The war with the world, which is not a war at all, because they're all coming here. Japan is coming here as we speak. They're in a plane flying, lots of them, all tough negotiators. But things that people wouldn't have given us 2 years ago, wouldn't have even thought of it 2 years ago, 3 years ago, 5 years ago, 7, they're giving us everything. They don't want tariffs on themselves. And it's very simple. We're making deals and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%. Now, it sounds ridiculous, but they charged us for many items 100%, 125%. Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger, stronger than it ever was. And 26 Republicans will fight for every state, every seat, and every single vote. We're going to fight like hell.
And Trump's Treasury Secretary Scott Bessent joined him in doubling down.
It was a big mistake, this Chinese escalation, because they're playing with a pair of twos. We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
So let's see how we're shaping up ahead of the open on Wall Street later today. Of course, it has been an eventful week for U.S. equities. At this stage, futures suggest it will be more selling later today when Wall Street opens. And this continues some of the negative moves we had witnessed also yesterday. So let me run you through the session on Tuesday. We saw the S&P posting its first close below 5K since April 2024, so over the past year. In total, the S&P was down almost 1.6% on the day. And it was interesting because at one point it seemed that we were changing the narrative for U.S. Stock markets, but in the end we actually ended the day on more negative notes. The Nasdaq also ended the day down more than 2%. And thinking about what this has meant for, just the overall market narrative, it's important to take a step back and just try to understand what has been happening here. At first, many investors were actually thinking that there was room for compromise, that we could see perhaps the United States actually pausing this latest round of tariffs. Now there are growing questions as to whether we're actually going to see significant deals that could lead to at least some of these tariffs being actually canceled. Let's see. We have to wait for that, but that is not the narrative at the stage. And that's why I want to take you to the Asian market session. In fact, we actually just obtained news from the Bank of Japan. They are saying that they will be holding a meeting to discuss the international financial markets with the finance ministry as well. of course, this is very important here. We actually know that Japan seems to be ahead of the queue in terms of negotiating a trade deal with the United States, but no doubt that they are still very much focused on trying to put an end to these trade tensions with the U.S. But let's see how those trade conversations will unfold. No doubt looking at some of the moves in Asia, the Nikkei 225 at this stage down almost 5%, and more selling, for instance, for the Hang Seng, we're down 2% at the stage. Thinking about the European markets, let me show you how European futures are shaping up at this stage. Once again, they point to more selling in Europe. This is actually a contrast to what we witnessed during the session on Tuesday, Karen. We actually saw the Stoxx 600 gaining almost, 2.7% on the day. But today, as we are looking at the so-called reciprocal tariffs being implemented, there's this new round of tariffs on European goods. We're talking about 20% additional tariffs. Of course, investors looking at this and questioning whether there's actually room for negotiation, and of course what this means for the economic outlook.
There have been waves that the market has been dealing with. First the threat of the tariffs, then the impact of the tariffs. So as we talk about today, we're now seeing the impact of the tariffs. So what do businesses do? Do they try and stockpile? Do they try and get around the tariffs in the hope that they will be removed through negotiation? Or is this now starting to get passed on because it's hard and fast coming into effect today? That is one point. The other point is the market moves we saw yesterday. The commentary that Trump had that China wants to do a deal. This was very positive for the market action. I think what you're saying is that the market, if it gets any decent news flow, will be ready to rally very aggressively. But in the meantime, we now have an extension of the downside in a very almost disorderly way, because we've moved away from very violent selling on the stock market, and that, let's face it, that is still unfolding, to also now seeing disorderly moves in treasury markets. So typically if we're talking about some sort of fall economically, you would see those yields decline. That is not the case, and some are also viewing the outing that we had from the Fed the other week, from Powell, that this was very hawkish in the context of what we're seeing unfold, as well as whether there is some form of a buyer's strike. There is action from those now not wanting to hold American paper because of the disruptive effect of the Trump administration. So that is something that you cannot write off. The other factor here I will throw into the mix is whether we've got some sort of currency warfare unfolding through the lens of the Chinese trying to depreciate the currency. So again, these are incredibly violent waters, not even choppy, they're absolutely violent territory.
I also want to go back to the point of what this means for the Fed, because I'm wondering what are they going to do. They have been very focused on inflation. They keep saying, of course, that obviously these tariffs are inflationary. They're going to bring even more inflationary pressures for the U.S. economy. But then if we see a recession, what is the Fed meant to do? Do they hike? Do they cut? What is the right balance for the Fed here? And I'll just make one final point that, these tariffs are already having an impact on the economic outlook and on real lives. I was in Italy over the last couple of days. Wine sellers, they sell heavily, they export heavily into the U.S., telling me that American importers have paused orders for now in anticipation of today's round of tariffs. And what are they going to do? They're like, American consumers will be paying more for their wine, and they are looking at other markets to sell their wine into.
Well, that's in the inflation expectations. Americans now expecting, I think it was 75% now, expecting that prices will be higher from here. But in terms of what the administration wanted, I mean, we got the message loud and clear that they don't care about the stock market, that there could be some medicine for investors to swallow here. It doesn't feel like medicine. It feels like some sort of a drip that markets are now on, some sort of life-saving drip as they battle that out on the markets. But what the administration does care about is the 10-year yield. And what we have seen since just in recent weeks, the 10-year yield is now above the 410, 420 range it was on Liberation Day. And of course, it's also rallied since last year. So the administration is not getting what it wants in terms of bringing down that 10-year Treasury yield. You can see this morning, 4.43%.
That's right. But let me get you up to speed to what's happening in terms of some of these trade conversations. U.S. officials say that allies, including Japan and South Korea, will be given priority in trade talks. In fact, South Korea's trade minister is traveling to the U.S. after a call between President Trump and South Korea's acting president, Han Duck-soo, with Trump saying he's optimistic a deal can be reached covering trade and payments for the U.S. military presence in the country. Meanwhile, Japanese negotiators are looking to begin talks with the U.S. administration in the coming days, with President Trump saying he would seek tailored deals. Kaori joins us from Tokyo with more. Kaori, great to have you on the show. Perhaps just explain to us what we can expect from these conversations, where there's any indication that a feasible trade agreement is actually on the table.
Well, I think we're very far from that. But compared to the rhetoric that's coming out from the U.S. administration in regards to China, the U.S. Trading people are sounding very optimistic about their negotiations with Japan. I mean, take a listen to what Scott Bessent had to say overnight to CNBC.
The Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
And in this wide-ranging interview, he goes on to say that there could be a deal in terms of LNG, the Alaska project that's been very, very costly. He's saying that maybe the Japanese could provide some capital for that. So compared to the rhetoric that we're hearing with other trading partners, I think Japanese authorities here are relatively positive in the sense that they have first-mover advantage. But that is not to say, of course, that the economic impact is going to be any more muted here. I mean, I'm hearing numbers from between minus 0.3% to minus 0.8% impact on the GDP if these tariffs are in place for the next year. The other factor to consider is what does it do to monetary policy? And it's interesting that news reports are emerging that the Bank of Japan and the Finance Ministry will be holding a meeting in about 2 hours' time, so just after the market closes. It's not entirely unusual in times of huge volatility like this for the central bank to meet the finance minister, but given that the Bank of Japan is in a very delicate situation, I mean, before these tariffs, the talk was normalization, when are they going to raise interest rates? I mean, I would be very interested to see what the official comments are from both sides of this. But I'll just update you on the government comments so far this morning regarding these trade tariffs that kicked in. Look, the chief government spokesman, very, very muted, very, very measured. He's saying he's going to strongly urge the U.S. to review the measures, and they're going to discuss thoroughly without giving up. The foreign minister, Mr. Iwaya, telling Parliament that, look, free trade is in the benefit of the U.S. as well. So this is the point that they're going to be pushing. So this is an all-Japan effort, not just the trade minister, not just the economics minister, but Japan Inc. as well, because you have to remember cars are a big component, 25% tariffs, not only going to hit Toyota and the rest of the major automakers, but the thousands and thousands of small and medium-sized enterprises that are going to be hurt if these tariffs indeed stick. Guys?
Kaori, thank you very much for bringing us the latest there out of Japan. Kaori and Joji with us. Meanwhile, long-term or long-dated U.S. Treasuries are continuing to sell off this morning, with the 30-year yield breaching 5% in early trades. Our next guest says that if this selling continues, we could see an over-leveraged player seek a hasty liquidation as the financial shock unleashed by the new trade regime intensifies. Let's get to Joe Bruselas, who is the chief economist at RSM. Joe, thank you very much for joining us. We are seeing very strong moves now on the bond market, which is not going according to script. Just walk us through some of the pain trade that you think could unfold from here.
All right, so essentially what's called the basis swap trade. That's a leverage trade that's quite popular amongst the hedge fund community, is blowing up this morning. It's the gap. The hedge funds like to trade the gap between cash treasuries and futures. Unfortunately, right now, that's rendering the treasury market illiquid. The massive market volatility caused by the U.S. trade regime is now blowing up that basis swap trade. That's why you've seen the 10-year move to near 4.45 and the 30-year above 5%. It's well understood that under these conditions, you're going to get a hedge fund that's likely going to run into serious problems. And the lateral pressure could create issues for private equity and private credit funds. And we all have the memory of summer 2020 when this occurred, and it forced the Fed actually to step in to improve liquidity conditions. And of course, in 2023, when yields surged above 5%, at the long end, we had issues in local and regional banks in the United States. So right now, whatever the administration thought they were going to obtain by launching a multi-front trade war, it's clearly not working. It's now time for the administration to seek a near-term off-ramp. If they don't, we're likely to see this roll into Europe and into the North America session with much more pronounced losses, not just in equity markets, but now that the location is moved into global fixed income markets, that's where the real game is. That's got to get the attention of the administration here.
Joe.
And if they don't get on it, but we're going to have a much bigger issue.
Joe, if you're talking about a liquidity event here, we've been here before in history. Do you think the Fed, if this happens, is as willing to step in given the confrontation it's had recently with the administration?
The Fed's going to has got a horrible decision it's going to have to make here. We know that on the backside of this, that both inflation and unemployment are likely to rise. My sense is right now, even with the dysfunction I'm beginning to see in the market, it's not sufficient yet for the Fed to step in. It's likely going to have to get somewhat worse. Look, if a central banker has got pressure on both sides of their mandate, that's the mandate for maximum stable employment and price stability, they're likely to lean in the direction of price stability, which means they're going to be very reluctant to intervene. But again, sometimes you get overtaken by events, and the Fed will probably just want to manage one crisis at a time. This is going to be a multi-day phenomenon. It's why I'm sitting here in Austin, Texas this morning, just after 12 midnight, up talking to you guys in Asia and in Europe.
Joe, I would like to understand, and I appreciate this is a general question, but what is next for markets? Because we have seen such heavy selling over the last week or so, some actually wondering whether this is the moment to buy the dip. My question is, where do we go from here? For how much longer could this heavy selling continue for U.S. equities?
Well, I'm an experienced veteran of 2008. This could go on for much longer. That's the unfortunate true answer to your question. Until a floor is put in, meaning either the Fed and the other central banks step in and provide liquidity, and that may not necessarily stop the problem here, because the origin of the shock lies within the trade regime. That's the real issue. We're going to need to see the White House find an off-ramp, take it, and then allow this to calm down. They can negotiate. That's what their actual goal is, while things are much calmer. But for now, this is just going to continue, unfortunately, until we get to that day when the White House recognizes this is no longer tenable.
So what about the dollar?
Well, under these conditions, you would expect the dollar to weaken. It really hasn't over the last number of days. It's not moved much. But I get where you're coming from. It's hard for the dollar to retain its currency reserve status if one cannot trust the trade regime that's been put on by Washington. That's why we're having this discussion right now around, hey, are we going to continue buying dollars, or are we going to have to diversify our reserve? Now, my sense is the U.S. economy is too large. You've got the $30 trillion liquid U.S. Treasury market. And as this slows, the dollar will keep its status. But for now, I would expect more volatility, not less, across fixed income currencies and commodity space, in addition to what we're seeing in equities.
Joe, I want to come back to the yield curve a bit more, because we are seeing, of course, that increase at the 10-year. The market has been looking at how the Trump reciprocal tariffs were derived, and there's been a lot of pushback as to the methodology used, and some saying that is now weakening the process around support for U.S. assets. And we're seeing that even in the safest of safe trades. There's a feeling too that, look, treasuries could be weaponized. The Japanese may not be going there, but China could be. What do you make of the administration's ability now to meet some of those interest payments, and whether there's even more heat economically on the U.S. when these tariffs were designed to take the heat off the U.S. fiscal position?
All right, well, the administration can make the interest payments. That's not really in doubt here, okay? I just want to be very clear about that. The U.S. can make all its interest payments. The real problem is that we've had a loss of credibility and confidence in the administration's ability to actually execute on this, which fundamentally started with that nonsensical equation that was put forward. Look, within minutes, we had already solved for the Greeks on my team, and we realized that this isn't a reciprocal set of tariffs. They're actually punitive. And that's at the heart of what's driving all of this volatility. And why you're asking me questions about the dollar and making interest payments, which heretofore nobody would have ever questioned, right? Look, we are not having a financial crisis in terms of we're not having a dollar funding crisis. We're not having a situation where the U.S. isn't going to meet its obligations. It will. But right now, what we've seen is a loss of credibility due to an inept execution on the rollout of the trade regime and that unfortunate equation that was put out, which quite frankly just didn't sum up.
Joe, I'm afraid we have to leave it there, but thank you for your time today. Joe Braswell is Chief Economist at RSM. Now, President Trump says he will expand the impact of his tariff policies with the pharma sector next in the crosshairs after being exempted from so-called reciprocal tariffs in place from today.
We're going to be announcing very shortly a major tariff on pharmaceuticals, and when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here, and they're going to be opening up their plants all over the place in our country. We're going to be announcing that, so that's breaking news. Ladies and gentlemen, we have breaking news.
European pharmaceutical companies have warned that tariff policies could accelerate a shift in investment to the U.S. A sector lobby group has called for, quote, rapid and radical action from the EU to avoid what it describes as a risk of exodus. Coming up on the show, the U.S. and EU relationship is in focus as Giorgia Meloni gets set to meet Trump next week. We'll discuss more after this break. Plus, tariffs take a bite out of Apple as Microsoft overtakes it to become the world's most valuable company by market cap again. And in the wake of fresh tariffs on China, we'll get a read on the EU's trade outlook with Bernd Lange, chairman of the Committee on International Trade at the European Parliament. Do not miss that conversation coming up at 7:30 British Summer Time.
CNBC. Live ambitiously.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. My ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they all fell for them.
I believe in getting justice.
American Greed on CNBC.
Leaders of business and tech talk AI. Name another industry that has a $10 trillion total addressable market. That's why everybody should be excited.
There's an accessibility to generative AI. It's unlike any technology that we've seen.
And its impact on the way we'll live and work.
To make sure that we are skilling up everyone is something we owe to society.
It's not AI or people. It's AI with people. And that will cause an economic boom.
Highlights from Converge Live only on CNBC.
Real money, real debate, real-time moves. Scott Wapner, live from the New York Stock Exchange. Halftime report, CNBC.
New Zealand Central Bank delivered an expected 25 basis point of rate cut and left the door open to further cuts as global economies feel the impact of President Trump's tariff policies. The question is how many more follow suit as the Reserve Bank of India also reduced rates by 25 basis points and adjusted its monetary policy stance to accommodative from neutral. The central bank's governor said U.S. tariffs have added to uncertainty. Also discussion as to whether the ECB could be next off the block when it moves to meet next week. Now, the sell-off is continuing in Asia as Trump's 104% tariffs on Chinese imports come into effect. JP joins us with more on the Asian market moves. JP, we are seeing extraordinary dislocations and the dollar weakness is dramatic at a time where you would think there would be a flight to safety, plus, of course, the bond market. So what are you seeing across on those Asian boards today?
Well, Karen, good morning. And it doesn't seem there's any safety to be found actually in Asia. And it seems that the Tuesday rally, at least, was very short-lived based on how equity indices, the major ones from Tokyo to Taipei, are pulling back in significant fashion. We do want to start with Chinese markets, which you're seeing here actually on the board at the moment. And there was a sign, at least, that the Shanghai Composite was actually trading slightly in the green. Also hints, perhaps, that the national team or some of these state funds were coming in to prop up stocks. But as you can see here, the Shanghai Composite has now fallen to the red. The Shenzhen Bourse trying to mount a slight comeback so far. The Hang Seng also in the red, down by about 1.8%. It's because those tariffs now, effective today, seem to have doubled at least on Chinese goods, effectively about 104%. We also want to take a look at how the Chinese yuan is trading today, because we did hear from President Trump where he singling out the yuan and saying that China might be manipulating their currency actually to, in fact, better trade deals at least, or a better trade outcome for them actually. And we're seeing that the yuan, both onshore and offshore, are moving in odd fashion so far in today's session. In fact, moving so oddly that even my screen right now is flickering, as I can see. The Nikkei 225, also something to watch out for because of how it's pulled back and how it tried to rebound on Tuesday. But you can see it's back to losing ways, with the yen also looking a bit firmer today, and the Nikkei now back firmly in bear market territory. The banks are worth watching out for in Japan also because they're moving almost as volatile and as much volatility as the Tokyo benchmark. We did hear from Nomura where they said that the full implementation of the tariffs in Japan could bring down their GDP by as much as 0.6 percentage points again, which means that the talk of recession fears in the world's fourth largest economy continues to resurface and continue to intensify by the day. Across the rest of the region, we're all seeing significant pullbacks. And once again, the TAIEX also the market to watch because they are seen another day of punishing declines today, with the TAIEX also the latest in the markets actually to enter bear market territory. And there's nowhere to run, nowhere to hide so far on this Wednesday here in Asia, ladies.
Indeed, that does sum it up. But JP, thank you so much for joining us. Coming up on the show, our next guest has a warning for companies turning to machines at the expense of people. Mark McLean joins us, the CEO and founder of SailPoint, right after the break.
Journalism was always the perfect career for me. I've always been an egghead and a nerd. When I'm covering tech, my job is to really take these wonky and complicated topics and distill them down so anyone can understand. Ambition definitely fuels the tech industry. There's still this air of possibility when a new tech product comes out, that it can do anything, that can change the world. There's nothing better than breaking news, jumping on camera and telling everyone immediately what they need to know. I love what I do. No day is the same. I couldn't imagine doing anything else.
I strive to be intellectually ambitious. I want to be making connections, finding the right data so I can help our viewers see around corners. I'm based in Los Angeles, and talking to VC investors or Hollywood executives, I have a unique perspective on what's going on in this incredibly fast-changing world. I love being a business reporter. In covering technology, I'm reporting on change. Ambition can create change.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Welcome to Squawk Box. I'm Karen Cho with Sylvia Amaro, and these are your headlines. President Trump's new tariffs on the so-called worst offenders take effect, with the minimum Chinese rate now at an eye-watering 104%. But Trump says the U.S. is stronger than ever.
Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
The global equity rout accelerates with Asia sharply in the red and Europe along with Wall Street primed for more heavy selling today. And there's no safety in treasuries as yields spike. More disharmony in the White House. Elon Musk and Peter Navarro's tariff feud continues to play out in public, with the Tesla boss calling Trump's top trade advisor, quote, dumber than a sack of bricks. Germany's leading parties reportedly stand on the brink of a coalition deal after marathon talks late into the night.
Now, Tesla CEO Elon Musk has clashed with top White House trade advisor Peter Navarro in a rift which went public over the weekend when Musk posted on X that a PhD in economics from Harvard is a bad thing, not a good thing, seemingly referencing Navarro's degree. Navarro then drew the ire of Musk with his characterization of Tesla in an interview with CNBC on Monday.
Elon Musk and his Doge team is making a contribution to America in terms of waste, fraud, and abuse, and that's a very good thing for this country and the American people. When it comes to tariffs and trade, we all understand in the White House, and the American people understand, that Elon's a car manufacturer, but he's not a car manufacturer, he's a car assembler.
Elon Musk hit back Tuesday, calling Trump's top trade advisor a moron and dumber than a sack of bricks before apologizing to bricks. White House Press Secretary Caroline Leavitt brushed off the rift.
These are obviously two individuals who have very different views on trade and on tariffs. Boys will be boys, and we will let their public sparring continue. And you guys should all be very grateful that we have the most transparent administration in history. And I think it also speaks to the president's willingness to hear from all sides, that he has people at the highest levels of this government in this White House who have very diverse opinions on very diverse issues. But
we're going to talk about tech and this market environment with organizations increasingly using cloud workloads and AI applications. Our next guest says that in the next 5 years, the number of machine identities such as bots is expected to grow faster than human identities, and that poses a key problem when it comes to security. Joining us now is Mark McLean, who is the CEO and founder of SailPoint. Mark, thank you very much for joining us today.
Thank you.
And for stepping away from some of the market action, but I want to get into that first up because you landed in hot water effectively, very turbulent market. You had a very strong valuation, but since the stock is listed, it's down 25%, and you're in good company because just about everything else in tech world is down more than 20% as well. What do you make of how difficult the environment is for a fairly infant company like yours coming to the public markets in this type of environment?
Yeah, it's obviously been a little choppier waters than we might have anticipated. We are a return company to the public market, so we've navigated some challenging times in the past. We were public during the pandemic, for instance. So I think we've seen sometimes that when customers are faced with economic uncertainty and difficult choices, they often kind of stack rank what's important to them. And what they don't typically do is cut 10% off of everything. They stack rank and draw the line over some bottom set of projects and focus on the top. What we see is cybersecurity is still a huge focus of most organizations. And we're focused on something called identity security, which says, I need to protect the identities in my organization and their access to data. That is actually getting harder, not easier, in a realm of AI and software bots where so many kinds of technology, as well as people, are accessing data and exposing it in some ways that the organization doesn't intend. That's our focus.
I've heard it firsthand at a lot of technology events in recent months that if you're going to have more AI, you're going to need more cybersecurity. It's almost a twin trade. But there is a view on markets now, and we heard it from a top tech analyst even in recent days, that there could be a setback to technology now from what we're seeing from the Trump administration. If we are going to get a slower rate of adoption around new technologies like AI, where does that leave cybersecurity?
Well, I think the nature of cyber is that the threats come from many different types of sources. What I don't think is going to change as a result of any policy in any government is that the bad actors that range from, nation states to criminals and others, they're always looking for ways to break into organizations and get at their data for various reasons. What we know today is true is that the primary attack vector of choice is coming into steal identities and then access. So if I can break through your firewall, which is technically very hard, that's great. What's easier is to convince you to give me your identity and password. Now I can just log into the systems and get the data I want. So people are very focused on protecting that information. And with this era of bots and AI, which I agree may slow a little, it's not going to stop. There's still a lot of motivation of these companies to invest in technology. Matter of fact, pressure on costs to reduce workforces may increase the goal of using AI to offset some of that work, right? So there's a lot of dynamics. What we see is that companies are still very focused on protecting themselves and their data, and identity is the attack vector of choice, which positions us well to help them.
I'm also curious as to whether you have witnessed any sort of interest now that we are talking more about spending more on defense, whether that has actually translated into cybersecurity as well.
We certainly know if you talk to the intelligence community or the defense community, they of course are still focused on classic traditional warfare, but increasingly on cyber warfare. And I don't think anybody seems to believe that's going to lessen anytime soon. Matter of fact, if China continues to be the primary adversary of concern for the U.S. and other Western nations, I think what they're going to find is they're even more focused on cyber attack, I should say, and therefore cybersecurity is a high priority. So I think we don't see any sense that from governments around the world that they will have any diminishing of their desire to protect their information through that means. And we're also, of course, focused on critical infrastructure, which again, while it's not attacking the government, it's attacking the core infrastructure of a country, which can cripple it in many ways.
Let me go back to the ongoing market turbulence, however. Now, being a listed company, I'm wondering how you are reading this turbulence and what that means for your outlook. How do you prepare? How do you take business decisions at this stage, really?
It's such a good question. I think everybody feels like we had some level of, quote, noise in the environment. The last week has been particularly noisy, right? So I think what you often do in those situations is, while you don't want to lean too far backwards and change your momentum, you get a little more cautious. And I think where we are is we're leaning in because there's still clearly strong demand signals from our marketplace, and then watching whether the customers are actually going to be able to execute some of their plans. What we feel good about, like every organization, we're talking to the customers, the potential customers, validating that in fact this is still a very high priority for them, but everybody's dealing with a pretty high level of uncertainty right now. So I think what we're going to do is stay highly engaged with our customers, make sure we're ready to continue to support them, and then see if there's actually short-term actions. Again, our best metaphor here is the pandemic. People rocked back on their heels for a moment. Once they kind of got their balance again, most leaned back in. I did say to folks the other day in an interview, we didn't sell to a lot of airlines during the pandemic. Certain industries are obviously harder hit than others. That'll be true in this tariff situation. But generally speaking, we feel like a lot of organizations are going to have to lean forward on some of their efforts, and cyber continues to be an area of priority. So we're not seeing a lot of signals of great concern yet.
And do tariffs catch up with any of the hardware in cybersecurity? Is that something we're going to have to think about, the repricing for the industry on some of its packages, which seem to be more software, but really there is some hardware too?
That's a great point, Karen. I think at one level, many of us are in the software business, but of course our software runs on servers and Amazon data centers and other places. So to the extent there's some underlying cost structure impacts there, we may feel that a little. In the software business, I think that's going to be relatively muted. I think we might see a cost increase that shows up a little bit in our underlying infrastructure cost, but most software companies, our primary cost is people, right? So at the end of the day, if we don't see sudden changes in that environment, we probably won't feel a lot of cost issues that we have to pass to customers.
Mark, thank you so much for joining us. A terrific conversation.
Pleasure.
Mark McLean with us, the CEO and founder of SailPoint.
Thank you.
Now, in other news, Apple was the world's most valuable company in terms of market cap, but President Trump's tariffs have taken a bite out of the tech giant, now allowing Microsoft to reclaim the title. Apple had its worst four-day stretch since 2000 after President Trump's big tariff reset, with the stock plunging 23%. The iPhone maker was hit particularly hard because of its reliance on China for production. The company is now more than 33% off its 52-week high it hit the day after Christmas. And let me get a check. We have the chart on the screen right now. It's quite unprecedented, really. All of these moves, when you think about what is the company that has the highest market cap, I feel like we have been discussing this quite regularly over the past year or so. Is it Microsoft? Is it Nvidia? Is it Apple? Ultimately, though, I'm wondering here, what is the outlook for Apple too? That we are looking at this narrative coming out of China that is very strong too. They are not backing off when it comes to trade retaliation. They are prepared, as I said, to go until the end and protect their economy too. So I'm wondering how is that going to help or hinder negotiations with the White House, and whether that could actually calm down the markets or not, really.
For me, Apple is right in the crosshairs of this trade story, because Trump wants more manufacturing at home and has pointed out that he wants more iPhones made at home. But if you do the numbers on the cost that would mean for the consumer, then Dan Ives put a number out there which is higher than one of the original numbers that was volunteered to the market. And Dan Ives from Wedbush, one of the most senior technology analysts, says that if an iPhone were made in the United States, it would cost $3,500. I saw a number recently that was just above $2,000, so this is even higher than that figure, $3,500. Who would be willing, even if it's on finance and even if it's spread out over 12 months, to spend $3,500 on an iPhone? I mean, you drop it or it goes missing and suddenly you're up for a fairly huge replacement cost. We're talking about big ticket items that are still very small here. So is that feasible? And I think it goes back to do we just want some of the manufacturing to happen in the United States, or do we want all of it to happen there? And this is the negotiation. How serious is Trump about bringing large-scale manufacturing to the U.S., even if it drives up the cost of businesses and for consumers, versus that end game potentially of negotiating with other countries and still seeing some manufacturing take place elsewhere?
I mean, you see already Apple looking at India as an alternative, at least for the time being. But of course, no one has escaped so far these trade tariffs. Coming up on the show, Bitcoin slides as investors move away from risky assets amid fears of an escalating trade war. We'll be live in Paris at the Blockchain Week after this break.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weekdays.
Leaders of business and tech talk AI. Name another industry that has a $10 trillion total addressable market. That's why everybody should be excited.
There's an accessibility to generative AI. It's unlike any technology that we've seen.
And its impact on the way we'll live and work. To make sure that we are skilling up everyone is something we owe to society.
It's not AI or people. It's AI with people. And that will cause an economic boom.
Highlights from Converge Live only on CNBC.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward.
The number one soft skill is flexibility,
preparation,
confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
Let's take a quick look at cryptocurrency prices this morning. Don't forget there's been a huge link between crypto and tech has been absolutely smashed, as we've been talking about. Crypto prices this morning modestly downbeat again. I'm going to say modest territory, given I think when we talk about larger percentage swings, it's single digits, 4, 5, 6 or more % in the sector in terms of daily swings, and what we've got down 0.7%, but 76,500, the number that we're trading below today. There are interesting comments out actually from one of the ECB governors today about the need for some form of a digital euro in this time of geopolitical crisis in terms of settling payments and not being reliant on international payment systems. I thought that was a fascinating comment this morning. But meantime, elsewhere, Ripple has announced it will buy multi-asset prime broker Hidden Road in a deal worth $1.25 billion. The acquisition is expected to close in coming months. Hidden Road has more than 300 institutional clients and clears nearly $3 trillion annually. The impact of Trump's tariffs on the sector will no doubt be a key topic at the Paris Blockchain Week, which is where Arjun joins us from today. Arjun, it is certainly a very different market environment today versus what you had 12 months ago. Just to walk us through how cryptocurrency sector is bearing some of the brunt of this sell-off that we're seeing on risk assets.
Yeah, you're absolutely right, Karen, when you said just a moment ago the way that you often see the crypto markets linked to what's happening in tech, and you're seeing big risk off here in the markets. There's billions of dollars that have been wiped off crypto markets just over the past few days as a result of the turmoil we've seen globally in financial markets as well. And the crypto industry is certainly feeling that. You said Bitcoin there just trading about $76,000 is well off the all-time highs of more than 100,000 we saw just a few months ago. Now, remember that big rally to the all-time high was very much driven by this Trump rally. He campaigned on a pro-crypto message. The industry backed him. There were hopes that there were going to be some huge changes in terms of regulation, in terms of support for the industry, but the tariffs have kind of derailed that. So how is the industry feeling, and where does this market go next? Those are the conversations I was having here at Paris Blockchain Week, starting off with Monica Long, the president of Ripple, to get her take. Let's listen in.
Certainly the macro environment has become very volatile, like you're explaining, and uncertain. And so I think we at Ripple, we in the industry, we are kind of watching to see what happens, how this plays out. Within crypto, I can say that, within the microcosm of crypto, there's been a lot of market volatility since the beginning. So high times, low times, long low times, the winters as we call them in crypto. And the technology is here to stay. And so especially at Ripple, we really take the long view of build. If we build things that solve problems and there's real utility behind it, then, everything else kind of sorts itself out.
Yeah. Are there any risks at the moment that you see that may spark another crypto winter, or do you think the industry is on a lot more solid footing than it was when we saw the sort of last downturn?
Yeah, it's a good question. Crypto certainly exists within the macro economy, so it's I don't think it's it will be a part of the bigger picture. However that pans out, we're going to see. But in terms of any specific risks to the crypto ecosystem, we're in a sturdier place. If I think about the triple S crisis, the crisis from a couple years ago with the banks, Signature and Silvergate Bank kind of debanking crypto, that was a real systemic risk. It was very fragile.
I think something the Ripple president alluded to there was the fact that the crypto markets historically have been extremely volatile, and the people who have been in this industry have been used to the big swings in prices and the market, upturns and downturns as well. But the question is, are we heading for a new crypto winter, a prolonged period of downturn in this market? That's something I put to Charles Hoskinson, the founder of IOHK and the blockchain Cardano, during my conversation with him. Let's listen in.
What ends up happening is crypto benefits in the long term, because geopolitically what's happening is we're moving from a rules-based international order to a great powers conflict. Now, we're kind of young, so we spent our entire adult lives under a rules-based international order, but our parents and grandparents, they lived under great powers conflict. It was the United States and the Soviet Union going at it. So it didn't matter what the trade deal was. It didn't matter what the rule of law was. If the Soviet Union wanted to do something or the U.S. wanted to do something, they just do it. And now we go back to great powers conflict. If Russia wants to invade Ukraine, it invades Ukraine. If China wants to invade Taiwan, it's going to do that. So treaties don't really work so well, and global business doesn't really work so well there. So your only option for globalization is crypto. If you want to do business with countries the United States doesn't like, or Russia doesn't like, or China doesn't like in a global commons, you can no longer do that through treaty organizations or legacy banks and things. You can only do that through crypto.
Just to get back to kind of where we currently are, you don't think we're heading towards another crypto winter at all?
No. I think Bitcoin will be over 250,000 by the end of this year or next year.
What's going to drive that, do you think?
What will happen is that the tariff stuff will be a dud, and then people will realize that the world is willing to negotiate. And it's really just U.S. versus China, and a lot of people will side with us, some people side with China. The markets will stabilize a little bit, and they'll get used to the new normal.
So Charles Hoskinson there believing that you might see Bitcoin at about 250K by the end of this year or next. Feels, just to sum up, they feel the market's more resilient here at the Paris Blockchain Week as well. But it's interesting, Karen, that the ECB comments you mentioned as well, because what Charles Hoskinson was alluding to there was this idea that crypto could be used to go beyond international payments rails. There's a lot of discussions here around stable coins. These cryptocurrencies that are pegged to another currency such as the US dollar or the euro and are backed by real world assets, and these are being seen as types of digital assets that could be used to move money around the world outside of traditional payments rails, and also with very low fees as well. That's a huge conversation at the moment. Ripple has also very recently launched its own stablecoin, so those are a big focus here at Paris Blockchain Week as well. But in terms of the market feeling, yes, bit of watch and see and what's happening with Trump, with tariffs at this point. It's had a huge impact on the market, with billions wiped off just over the past few days, and certainly the industry players right now are hoping that there might be some sort of silver lining at some point going forward. Back to you guys.
Thanks for the update, Arjun. We'll speak to you later on. And moving on to European politics, the German coalition talks have reportedly been paused after 13 hours of negotiations. That's according to the German public broadcaster Tagesschau. It has been expected that the CDU, CSU and SPD could reach an agreement overnight. The parties are now said to be working towards an agreement by midday today, with talks scheduled to resume this morning. And the Italian Prime Minister, Giorgia Meloni, is set to meet the U.S. President Donald Trump next week for an official working visit. Meloni will visit the White House on April 17th, the first European leader to meet with Trump since he announced 20% tariffs on goods from the EU last week. So a very important meeting, no doubt.
We'll get into that in a moment, but in the meantime, we've got some breaking news, and this is from France this morning. The French European Affairs Minister Haddad has said that he reaffirms he has hopes for talks with the United States over tariffs. The EU must show a united front on this, but then going on to say Europe must show it can react and inflict damage on the American economy regarding tariff situations. So again, talking about Europe having more teeth in its negotiations.
And at the same time, out of France, we're also getting news comments from the business lobby, MEDEF, saying, of course, I am worried about the impact of U.S. tariffs on French business. The head of the Business Association saying that there is a risk of economic slowdown and possible recession, and calling on the French government as well to act to boost the company's competitiveness. So all of this kind of blends in, Karen. We have the fact that businesses have started to be really concerned about these tariffs coming from the United States. At the same time, pressure on European leaders to do something about it, to perhaps find a compromise with the United States. All eyes on Meloni to see whether she'll manage to do that. But ultimately, is the U.S., is President Donald Trump actually listening to the Europeans at this stage? It does not sound like that at all.
Politico has a great article on this as to what can be achieved from Meloni in these negotiations, as she has a somewhat more favorable relationship with Trump than other European leaders do at this point. But the article is talking about what is the aim here, what can she negotiate versus just emerging unscathed, which is what the Irish leader did recently. So does having a good relationship make any difference at this point? Or do you need to see leaders recalibrate? And if you look at China today, it is not blinking. 104% tariffs. It's not blinking. And do you need to see Europe take a tougher approach to the United States versus simply just rolling over and trying to offer up a reduction in tariffs? Is that enough at this point?
The Europeans have been very clear. They want to have some sort of a deal. They do not want these trade tensions to escalate even further. The idea is to come up with an agreement that will basically cancel, if not all, at least some of these tariffs. But Giorgia Meloni is in a very difficult position because she has pressure from her European counterparts to deliver, to do something for the European Union. But at the same time, she cannot be seen to some extent as too close to Donald Trump. She needs to take into these conversations the European interest. She needs to highlight what the European Union wants. And here I would just highlight that there is a common narrative from the US and the Europeans, and that is on energy.
Yeah.
So it could be that we could actually see the Europeans and the US agreeing on some sort of deal to remove these tariffs, at least partially, if the Europeans say, yes, we'll buy more American energy. The Americans want that. The Europeans are keen to buy more American energy, so that could be the solution. But for the time being, that is not on the table,
Which was a known area of discussion. I mean, we were talking about this with Christine Lagarde over at the ECB many months ago, that this could be the way forward. So it's not an unknown topic of discussion, but the point is what is taking so long here. In terms of what you're seeing on markets, though, I think it's fascinating that euro has bounced. So there has been some confidence on this side of the world, at least in the currency, that's been expressed, even with the notion that perhaps the ECB is going to have to reduce at its April meeting. So in that context, we were talking about rate cuts from the ECB, but not necessarily from the Fed yet. We've still got the currency bouncing nearly 1% in morning session, which I think is absolutely fascinating. But the other point of this is that Europe wanted to unlock a huge amount of savings to get behind all the initiatives that have been announced. Just how confident do people feel about putting money into stocks at this point, given the market turbulence? So I think Europe is in somewhat of a pickle at this stage too, because it is not necessarily a safe harbour around defence and infrastructure when you have market events like this playing out.
So a lot of pressure on all sorts of the business, the political decision-making process. And we'll have a chance to get a read on the EU's trade outlook with Bernd Lange, chairman of the Committee on International Trade at the European Parliament. Do not miss that conversation coming up at 7:30 London time.
And before that, though, President Trump's tariffs continue to roil markets and reshape global trade. We'll have the latest after the break.
Can't miss reporting that impacts your money now. Be here when the opening bell rings. Squawk on the Street. CNBC.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
Leaders from the world of sport talk tech.
You have technology that is now allowing coaches to reduce the risk of injury.
AI gaming is going to be one of the most fundamental disruptions.
And new growth opportunities.
There's an opportunity for us to come together, for players to play across different platforms. I think that's really wonderful.
What do you do while you're watching sports? Not everybody likes the lean back experience. People like to lean forward and engage.
Highlights from Converge Live, only on CNBC.
I'm going to show you the way Vietnamese people enjoy coffee in the morning. I live here and I have to say that I love the traffic here, which seems like chaos to foreigners, but it's actually an organized chaos. Everything works. Xin chào. Hello, my name is Khánh Vi. I'm a content creator and a TV host from Vietnam. Here we are at District 1, which is the central of Ho Chi Minh City. I think this is one of my favorite spots in the Independence Palace. This is the way of selfie for Gen Zs. 0.5. I'm originally from the north central province of Nghệ An, but I've stayed in Ho Chi Minh City for a couple of years now. Ho Chi Minh City has such great energy, and you can feel that when you come here. Winter Boulevard. And I'm so excited to bring you around our largest city in Vietnam. And here's what I do in my downtime.
Hello and welcome to Squawk Box. It's the second hour and it's a busy old day. I'm Karen Cho with Sylvia Amaro. These are your headlines. President Trump's new tariffs on the so-called worst offenders take effect, with the minimum Chinese rate now at an eye-watering 104%. But Trump says the U.S. is stronger than ever.
Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
The global equity rout accelerates. Asia is led lower by the Nikkei as Japan's hopes of a rapid trade deal fade, while futures point to more heavy selling across Europe and Wall Street ahead of the market open today.
The sell-off spreads to bond markets as long-dated yields surge across the globe, with the 30-year U.S. Treasury yield spiking to its highest level in over a year. And more disharmony in the White House. Elon Musk and Peter Navarro's tariff spat continues to play out in public, with the Tesla boss calling Trump's top trade advisor, quote, dumber than a sack of bricks.
It's a strange old market we're looking at. The big moves we've seen on stock markets clearly demonstrated again overnight, but yields spiking stateside, dollars selling off in this context. The moves are fairly extraordinary again this morning as the U.S. has implemented its harshest tariff regime in over a century, with what the White House calls reciprocal levies coming into effect on countries ranging from Algeria to Zimbabwe. Futures are selling off both sides of the Atlantic, with investors also spurning treasuries. Yields are notching double-digit basis point surges on the long end of the curve this morning. Don't forget, we're talking about the safest of safe trades here, so fairly large moves being displayed there. Meanwhile, the offshore yuan is paring losses after it hit its weakest level on record overnight as China grapples with 104% levies on goods sold to America. The foreign exchange moves, are we looking at disorderly moves and some sort of currency devaluations here as we again take a look at the next wave of this trade war? Speaking last night, President Trump was defiant on the issue.
The war with the world, which is not a war at all because they're all coming here. Japan is coming here as we speak. They're in a plane flying, lots of them, all tough negotiators, but things that people wouldn't have given us 2 years ago, wouldn't have even thought of it 2 years ago, 3 years ago, 5 years ago, 7, they're giving us everything. They don't want tariffs on themselves. And it's very simple. We're making deals and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%. Now, it sounds ridiculous, but they charged us for many items 100%, 125%. Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was. And 2026 Republicans will fight for every state, every seat, and every single vote. We're going to fight like hell.
Trump's Treasury Secretary Scott Bessent joined him in doubling down.
It was a big mistake, this Chinese escalation, because they're playing with a pair of twos. We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
So let's get a check on U.S. futures now that these tariffs are implemented. Thinking about the U.S. markets, they are pointing to a negative start to the trading day on Wall Street, so more selling stateside after what was also a downward beat session on Tuesday. Let me show you how U.S. Major indices closed yesterday. As you can see on your screen, we were red across all of the major indices. S&P actually ended the day down 1.6%. The Nasdaq down about 2% as well. And the guest earlier on in the show suggesting that the heavy selling we have seen over the past week on Wall Street is likely to continue. Let's see how equities will fare later today. Thinking about treasuries, let me take you to that market too. Once again, what an interesting time to say the least, really, looking at some of these moves. Taking you to the 10-year yield treasury, we are now at 4.415%. I like to always take a broader look and thinking about the context here. We started the year discussing whether we're going to reach 5% on the 10-year treasury yield. The recent moves in this market have been volatile as well, to say the least. At this stage, we are just above the 4.4% handle. Thinking about European futures, let me also show you how those are shaping up at this stage, how we're likely to open in Europe. And here is a different narrative from what we witnessed yesterday. The Stoxx 600 ended the day up 2.7%. We saw actually a rebound across all of the major bourses in Europe. But as the future suggests at this stage, we are on track for a different story today, as now these latest round of tariffs from the United States, which are effectively applying a 20% tariff on European goods, are now in effect. The sell-off is continuing in Asia as well, as Trump's 104% tariffs on Chinese imports came into effect. JP joins us for more on the Asian market moves. JP.
Good morning, Sylvia. And yes, that 104% tariff effective on Chinese goods is what's front and center, what's causing a lot of investors here in Asia to get spooked and also wiping out any hopes of that relief rally that we saw on Tuesday. But here's a surprise for you ladies, actually. And we're seeing today that in Chinese markets, Shanghai and Shenzhen are actually in the green and starting to look a little bit more confident as near the close in both these major markets. Now, there has been talk of these state funds, the national team coming in to prop up the equity markets, and this could be one of those signs that we're starting to see some of these funds coming back in to support Chinese stocks in today's session. But again, the question is, how much more ammunition do they have to actually support these stock markets? We did hear from Goldman Sachs saying that any tariffs on China or these tariffs now could bring down China's GDP by about 2.4 percentage points, which means the world's second largest economy could get hit hard by these tariffs, especially as they're trying to stay defiant against the face of the Trump administration's own tariffs being levied on these Chinese goods. Take a look at the Hang Seng, which is missing out on this broader rally on the mainland. And we'll get back to the Hang Seng in just a little bit, but they're starting to see signs of stabilization out in Hong Kong as well. We look at other markets in Asia at the moment, and again, it's a wall of red to varying degrees again. The South Korean Kospi down in today's session, falling by about almost 2%, despite the fact that they've also pledged some support for the ailing auto sector amidst all of this tariff uncertainty. Take a look at the ASX 200, also declining as we see a number of key commodity contracts on the Dalian exchange, such as iron ore and coal, actually fall, and that's also pulled on the miners out in Australia. The Nikkei 225 and the TAIEX also down, and the Nikkei 225 back to losing ways. And these two markets are worth watching because they are both trading in bear market territory. Take a look at this 2-year chart, this 1-year chart for these two markets again, and you'll see the Nikkei 225 has been pulled back into the den of the bears, and the TAIEX continues to fall deeper and deeper into the bear markets, which brings us back to the Hang Seng. Yes, things are looking a bit more stable out in Hong Kong as we near the close at around 4:30 p.m. Singapore, Hong Kong time later on. But keep in mind, at these levels, they're about 600 points and change away from also testing bear market territory. And it seems any of those gains we saw with regards to the AI boom, with regards to the DeepSeek sparked rally, has now been wiped out, at least for the time being, because now it's not DeepSeek, it's not AI. The concern now for markets in China and across Asia at the moment are these tariffs and what it'll do to the economy, what it'll do to the market, and also valuations across these many markets. And again, only time will tell, but so far this might be just the start of what might be a painful summer for markets here in Asia. Ladies, back to you and good morning.
Thank you for the update, JP. Meanwhile, U.S. officials say allies, including Japan and South Korea, will be given priority In trade talks, South Korea's trade minister is traveling to the U.S. after a call between President Trump and South Korea's acting president, Han Duck-soo, with Trump saying he's optimistic a deal can be reached covering trade and payments for the U.S. military presence in the country. Meanwhile, Japanese negotiators are looking to begin talks with the U.S. administration in the coming days, with President Trump saying he would seek tailored deals. Let's discuss this and all the market turbulence with Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock. Alex, great to have you on the show.
Morning.
I'll start actually with your title, Portfolio Solutions. At this stage, so much turbulence in the market. What is the solution for the portfolio?
Well, I think the last week, or probably the last few months, have actually been a reminder that A, we're in a new world now. This is not a situation where a classic broad stock index, broad bond index, set and forget portfolio is ideal. And I think there are two main reminders. One is you need to be agile in your allocations, and the tools are now there to do that. We have seen record trading in many of our ETF instruments as people adjust very quickly their positions, and that liquidity has been there. Those markets have been high quality, which is the tools are there. Portfolios can adjust. And the second is you need diversification for stagflation. This is not an environment, and overnight we've seen that very clearly, where duration is your friend as a nice negatively correlated stock diversifier. But the tools are there for that as well.
I want to get your thoughts in more specific about the European stock market. We started the year looking at this outperformance for European equities. Now, of course, a lot of volatility also for this part of the market. I'm wondering, what is the outlook here?
Well, we did start the year, and I came on here a few months ago and explained that some of our tactical asset allocation teams had turned positive on Europe around about late November, early December, given where positioning and valuations were. Those positions were faded away in the early part of the year as the rally took hold. And I think now the opportunities in Europe are much more selective. This isn't the case of there's a second leg to that run. There's been a fundamental shock. And I think actually a lot of what we're looking at here isn't a question of is this a market dip that's going to come back again. The market's trying to price a really fundamental shift in global trade policy and the macroeconomic and company level implications of that. And we're going to see a lot more volatility. But within Europe, it's interesting to have a shopping basket ready for when people are ready to step in. Our own clients are completely split down the middle between people who are looking to buy and people who are looking to defend more. But it's good to have a shopping basket ready, and it needs to be pretty precise, I think, rather than the broad index. And so we're looking at things like European banks, where there are risks, but they're in a much better place and the valuations look reasonably attractive, and things like European healthcare, which also look more resilient to the global trade picture as well.
Let me test the European bank theory, because I've seen that huge spike that we had. And, we had a conversation when we were towards the highs of this trading range for 2025 with a very top equity analyst saying, buy European banks. To say even at this point, and of course, we've come off massively right back towards early levels from the start of this year. So wiping out the complete upswing in the European banks. If the ECB is looking at the economic outlook and has to cut rates this month, when, let's face it, it's been a bit of a two-way bet as to whether April was really a live meeting, if it's seeing the consequences of that economically, what is the argument of holding banks when rate cuts are going to be coming?
So I think rate cuts are coming in Europe, and that's a bit of a difference actually to the US, which maybe we can come on to in a bit. But I think for European banks, it's about the resilience of their net interest margin to the likely rate outlook and where the valuations are right now, given that it's already priced. So it's not the case that they won't suffer a bit. It's that they are resilient and it's priced pretty aggressively.
So versus the United States, I mean, that was the other compare and contrast, where the Fed, we don't know if they're going to be cutting it. It sounded very hawkish, the last outing from Jay Powell. He's keeping his powder dry at this stage. So how do you weigh up the difference between the two?
Yeah, I think what the Fed's facing now is a very clear, directionally, stagflationary shock. Inflation's going to be much higher this year as tariffs get passed through to consumer prices. Growth's going to be materially weaker. And so I was pretty surprised, actually, that yields fell quite so much and so many rate cuts were priced in as this situation unfolded. Still got quite a lot priced in. That looks unrealistic to us at the short end. And it goes to this point about portfolio solutions and needing diversification against stagflation. So duration isn't your friend here as a diversifier. And actually, portfolios are much better served by taking down that broad market beta risk and using things like liquid alternatives where you're looking at alpha plays that are uncorrelated with the broad market to try and deal with the fact that you haven't got this nice negative correlation anymore.
And what's bugging me about this year is that everything I've heard is then undermined the next week by sell-offs. And even when it comes to bond portfolios today, we heard the other week the 60-40 is back. Is it? When we see...
Well, you wouldn't have caught me saying that.
Well, we did from very top managers saying, look, 60-40 is working again now. Look at the bond market. That's your safe haven. It is not a safe haven today.
I think that goes to looking at the fundamentals of the US bond market here. We've got some technicals going on. We've got early signs of stress in the swap market in front of us. That bears close watching. But more fundamentally, we've got a very different to the past fiscal position in the United States. Very wide deficit, higher interest rates, likely weaker growth. That fiscal trajectory, the debt trajectory is not that pleasant, right? And we haven't got that much term premium in. Plus, we've got a more inflationary environment. All of that stacks up to thinking there should be more term premium in US assets. We've thought that for quite some time, which is why we've typically lent into alternative ways of taking down broad market beta as a way of diversifying in portfolios.
I would like to get more color from you on the strategy around diversification for stagflation. Walk us through what other options are out there for this diversification.
Well, there's the kind of immediate headline, which is gold. Gold has proved itself a reasonably good diversifier, much better than long-term US treasuries in this environment. But there's also, as I mentioned, some of these strategies that take down broad market beta in the portfolio, liquid alternatives, strategies deliberately designed effectively to make long-short calls, deliver cash plus rather than market benchmark plus. And those, by diversifying the risk sources in the portfolio, can actually take down the overall risk level in the portfolio. And I think the third is, when it comes to the equity market sleeve itself, is A, to be more precise about the building blocks, rather than just by the acqui, say. The building blocks are there to be much more granular now, and also to be pretty nimble around your treatment of factors in the equity market. We've seen the minimum volatility factor, as you would expect in a time like this, perform pretty well. And also we've seen factor rotation strategies that can get ahead of these big rotations, like we saw a few weeks ago, actually perform pretty well too. So it's a case of kind of reconfiguring the equity sleeve in those ways, reconfigure the fixed income sleeve for all these risks we've been talking about as well. So I guess to go to your point, it's the complete opposite of 60 broad equity, 40 broad bonds.
I want to dive a little bit more into that 60 because yesterday we had a glimpse of the market trying to position around positive news flow, and this was Trump specifically saying that China wants a deal. I think the market was saying, was this just one big game to try and lower borders everywhere? If that were the outcome, then that surely would be positive for the US economy as well. And we were seeing this bromance breakdown, I think, in some quarters, Navarro versus Musk, where Musk is apparently just a car assembler now, according to Navarro, which I think is just extraordinary given all the technology that goes into a Tesla. But it does tell you that all is not well in the administration at this point. And if there is some sort of negotiation, what would that do to quarters of the market that have been heavily beaten up? I mean, it's not just the NASDAQ down here on 25%, it's the Russell 2K down about 28.5%. Are there opportunities to reposition even in those US major indices?
So I think what the market's been looking at in the last couple of trading days actually is any signal of any relief. And we saw it for about half an hour on Monday morning as well with the news story that turned out not to be true.
When 10 days of volume went through the market.
Yeah, and actually, that goes to the point that we have seen a lot of agility, and the tools have been there to do that. But at the same time, I think we've got to recognize there is some probability of some deals being done. I don't pretend to have any particular insight on that. I think the more fundamental thing for portfolios is we are in a new world. Policy, and we have been for some time, policy is now a contributor to volatility. So portfolios need to be constructed around that rather than, if you like, a bet that everything's going to be walked back.
Alex, great to have the chance to speak with you today. Thank you for your thoughts. Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock. In the meantime, I want to take you to some flashes coming out of China at this hour. China's top leaders will be holding a meeting as soon as Wednesday to discuss measures to boost the economy after the United States trade tariffs. This is according to sources, so Reuters sources. At the same time, China's top leaders are also reportedly set to discuss measures to stabilize capital markets. So again, I would like to reiterate, these are Reuters sources, but ultimately, if this ends up being the case, it just highlights really the pressures that China is feeling at this stage. They're very much focused on containing some of the pressures coming from the United States in terms of these additional tariffs. And just as a reminder, as of today, there's a 104% tariff on Chinese goods. So we are talking about significant levies here on Chinese products. And of course, this is likely to have ramifications not just on the American economy, but also, Karen, on the Chinese economy.
I'm just trying to make sense of some comments coming through from the BOJ. This is from Ueda, saying they must be vigilant to face uncertainty over each country's trade policy outlook, heightening underlying inflation below 2%, but now gradually accelerating, saying Japan's economy recovering moderately, albeit with some weak signs. We continue to raise policy rate if the economy keeps improving. A move in line with our forecast, must scrutinise without preconception at each meeting whether our forecast will materialise. I think that's fascinating, isn't it, that whether they've set in stone some of these forecasts and if they're far off the mark, what they do on the policy side. That is fascinating because I think that applies to the ECB too. It will take appropriate policy decision by examining domestic, overseas economic price developments with market impact. Alex, we've still got you here, so I might just bring you in because you did work in central banking a lifetime ago, I think.
Yeah.
What do central banks do at this point? We've had a couple of rate cuts today from central banks. Do you think we're now in that environment where central banks just have to react with an emergency setting, just cut rates? Are we back there yet?
No, I don't think so. I think it's different as well for the countries that are on the receiving end of tariffs, who are very clearly now facing a growth shock. So the ECB, for example, we talked about a moment ago, they'll be more inclined to cut now as growth forecasts have been revised down. For the Fed, it's a bit different. It's going to face higher inflation, and having been through one episode of transitory inflation, I think it's going to be more reluctant this time to respond really aggressively to growth downturns while inflation is heading north.
I'm also quite interested in the fact that Japan is actually ahead of the curve in terms of potential negotiating a trade solution with the United States. I'm wondering what that means also from whether this could actually lead the way for other negotiations and trade solutions with the United States. You know, as you sit discussing portfolio solutions, is your working assumption that ultimately we will be weathering the storm and actually seeing a trade compromise with the US and other parts of the world?
No, I think that, as we talked about earlier, I think it's a dangerous way to build a portfolio to say hope that everything is walked back from here. It could escalate in some respects, and in some deals it could be walked back. So it is going to be important to be really agile, because country by country it's going to vary a lot. So you've got to build a portfolio for the new world we're in, which is one in which policy, trade policy in particular, but macro policy more generally, is a destabilizing influence rather than the multi-decade period we went through where it was a stabilizing influence.
Alex, what worries me today as we take a look at this market sell-off talks about whether we've got a global recession now unfolding. In previous moments of crisis, we saw global coordination from central banks, Treasury Secretary as well. FOMC was picked up. We're talking about liquidity lines, swap lines, ensuring that there's smooth flowing systems. Is that in doubt if we need it? Can we rely on the fact that there would be global coordination?
I think in a situation like that, I think you can rely on the plumbing working. But as I said earlier, we have seen some early signs of stress in some markets. They bear very close watching over the next day or week. I think we can rely on those actions. But remember, when it comes to monetary policy, it doesn't necessarily need to be coordinated. Each central bank can take its own actions and end up delivering the same sort of result.
Well, they have built up some ammunition in recent years, haven't they, Alex? Thank you very much. Alex Brazier with us, Global Head of Investment and Portfolio Solutions at BlackRock. A quick look at how futures are shaping up as we head to break. Don't forget, yesterday we saw a bounce back in Europe. Was that premature in the context where the US markets again went on a roller coaster ride? So we are seen down this morning. We're looking to give back a lot of that territory. Let's just take a look at the DAX, down 3.4% early market. It was up 2.5% yesterday, so looking to give back more of that territory than what it scooped up in trade yesterday.
$1,500 movie? I don't want this flight to end. This is the game changer seat. Look, it even comes with binoculars.
Want to jumpstart your side hustle? Learn the skills to earn passive income online with CNBC Make It's new online course. Expert advice, real-life success stories. Register right now at cnbcmakeit.com/passive income.
How much would you pay for luxury travel? A week's stay costs almost $270,000.
It's on the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that money can't buy.
This is First Class, only on CNBC.
Real money, real debate, real-time moves. Scott Wapner, live from the New York Stock Exchange. Halftime report, CNBC.
Tesla CEO Elon Musk has clashed with top White House trade advisor Peter Navarro in a rift which went public over the weekend when Musk posted on X that a PhD in economics from Harvard is a bad thing, not a good thing, seemingly referencing Navarro's degree. Navarro then drew the ire of Musk with his characterization of Tesla in an interview with CNBC on Monday.
Elon Musk and his Doge team is making a contribution to America in terms of waste, fraud, and abuse. And that's a very good thing for this country and the American people. When it comes to tariffs and trade, we all understand in the White House, and the American people understand, that Elon's a car manufacturer. But he's not a car manufacturer. He's a car assembler.
Musk hit back Tuesday, calling Trump's top trade advisor a moron and dumber than a sack of bricks before apologizing to bricks. The White House Press Secretary Caroline Leavitt brushed off the rift.
These are obviously two individuals who have very different views on trade and on tariffs. Boys will be boys, and we will let their public sparring continue. And you guys should all be very grateful that we have the most transparent administration in history. And I think it also speaks to the president's willingness to hear from all sides, that he has people at the highest levels of this government in this White House who have very diverse opinions on very diverse issues. But
the rift suggests that somebody is on the out, whether it's Navarro or whether it's Musk, because you've got squabbling forces here. One is a free trade, the idea of free trade for Musk. It doesn't need any form of protection. He thinks his innovation will win out, versus Navarro that feels a wall of tariffs are necessary to protect U.S. manufacturing. So it feels as though one of them is going to be wrong at some point.
But ultimately, it feels that the decision is coming from the president, it's coming from the top. So I'm wondering whether this noise is actually filtering through to the president. Seems unlikely at this stage. I would just highlight the language here. Perhaps we don't need to use certain language in this context. You know, it seems a little bit too aggressive at times. Some of these words are just perhaps, not the most polite or the most civil for a U.S. administration at this stage.
Well, I mean, I think the bat that Navarro took to Musk, calling him an assembler of foreign parts. And the reality is that these are cars that people bought before the somewhat biased strike for the superior technology.
Yeah.
I think in some ways that is somewhat of a low blow,
a little bit too much. Well, anyway, we are going to get a read on the U.S. trade outlook with Bernd Lang, chairman of the Committee on International Trade at the European Parliament. That's coming up after this break, so stay tuned for that. We'll be right back.
Prime Infra's growth strategy rests on delivering essential services through critical infrastructure. For instance, in our water projects, we are building a very large water supply dam, the first one in 50 years. That dam relies solely on the watershed that it surrounds. Without that watershed being in a state of healthiness, we cannot collect the water we need, thus cannot serve our customers. Technology and digital transformation are cornerstones when we talk about executing extremely complex projects in complex environments at scale. Digital transformation is about optimizing our operations. It's about servicing our clients better. And I expect both technology and digital transformation to play a role for the very long term in the business on a continuous basis.
Welcome back to Squawk Box. I'm Sylvia Maru with Karen Show, and here are your headlines. President Trump's new tariffs on the so-called worst offenders take effect, with the minimum Chinese rate now at an eye-watering 104%. But Trump says the U.S. is stronger than ever.
Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
The global equity rout accelerates. Asia is led lower by the Nikkei as Japan's hopes of a rapid trade deal fade, while futures point to more heavy selling across Europe and Wall Street ahead of the market open. The sell-off spreads to bond markets as well as long-dated yields surge across the globe, with the 30-year U.S. Treasury yield spiking to its highest level in over a year. And more disharmony in the White House. Elon Musk and Peter Navarro's tariff spat continues to play out in public, with Tesla boss calling Trump's top trade advisor, quote, dumber than a sack of bricks. I want to take you to the activity, the action in Asian markets. We continue to see a lot of pressure for some of the bourses across the Asian continent. Let me take you to the Nikkei 225, down more than about 4% at this stage. As we highlighted earlier in the show, we are looking at these latest tariffs from the United States now in implementation. They are now coming into effect, and investors have been reacting to this news. The fact that there is no compromise for the time being, there has been no pause in terms of those reciprocal tariffs, and therefore investors very much questioning the outlook for the economy, but also for businesses at the stage. Let me just make a brief comment. Looking at the Kospi, we're down 1.7%. Let me bring you back to Europe and understand how we're likely to open in about 30 minutes or so. Futures point to more selling on the European continent. This is actually a different narrative from what we witnessed yesterday. There was a rebound in European equities on Tuesday. We actually saw the benchmark ending the day up about 2.7%. However, looking at these numbers, we are on track for a negative start to the trading day on the European continent, with now looking at these tariffs from the United States also into effect, meaning a 20% tariff on European goods. Let's see how the Europeans will react later today. There's a vote happening in the EU in terms of their first response to the initial tariffs on steel and aluminium. In terms of other asset classes, looking at European yields, let me show you those too. Let me take you to the benchmark, the yield on the 10-year German Bund. We are up at 2.6% at this stage. Also important in this context, Karen, to monitor comments coming from ECB officials. They are gathering on the 17th of April, and this seemed to be a bit of a mix in terms of what we're going to get from the ECB. But at this stage, with these tariffs now in implementation, many commentators suggesting that the ECB has no choice but cutting rates again.
Well, Sylvia, meantime, President Trump says he will expand the impact of his tariff policies, with the pharma sector now in the crosshairs after being exempted from the so-called reciprocal tariffs in place from today.
We're going to be announcing very shortly a major tariff on pharmaceuticals, and when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here. And they're going to be opening up their plants all over the place in our country. We're going to be announcing that. So that's breaking news. Ladies and gentlemen, we have breaking news.
European pharmaceutical companies have warned that tariff policies could accelerate a shift in investment to the United States. A sector lobby group has called for, quote, rapid and radical action from the EU to avoid what it describes as a risk of exodus. Italian Prime Minister Giorgia Meloni is set to meet US President Trump next week for an official working visit. Meloni will visit the White House on the 17th of April, the first European leader to meet with Trump since he announced 20% tariffs on goods from the EU last week. The Spanish Prime Minister, meantime, Pedro Sánchez, has urged the EU to rethink its relationship with China amid global tariff turmoil. Sánchez is in Vietnam currently, where he said it's time Europe found new partners and opened new markets. He will meet Vietnam's president and prime minister before heading to China, where he will meet President Xi Jinping.
And talking about the response to the United States in terms of these trade tensions, the European member states will vote today on the first round of retaliatory tariffs against the United States. That's in response to levies on steel and aluminium imports. The bloc is targeting about 26 billion euros worth of U.S. goods, including motorcycles and jeans. If approved, the tariffs would come into effect from mid-April. Now, this is in addition to the proposed tariffs. EU officials have reiterated that they are hoping for open negotiations with the Trump administration. So reiterating there how they're open for an agreement. So let's discuss the EU's position with Bernd Lange, the chairman of the Committee on International Trade at the European Parliament. Bernd, good morning and thanks for joining us today. My first question to you has to be around what is the best response for the EU, really? Because there seems to be two different schools of thought. One suggesting that it is too dangerous for the EU to retaliate, and of course we have the member states voting later today. Others suggesting that this is the only answer. Where do you stand in this camp?
Yeah, thanks a lot for contacting me, and I can confirm that we want to set really tariffs as a countermeasures to the illegal tariffs of President Trump. And yeah, we had the experience of the Trump first government, where we had we were confronted with the steel tariffs and the aluminum tariffs as well, and we set countermeasures, and after that negotiations were possible. And I hope that this will be the case also now, because at the moment it's a little bit uncertain what President Trump is really wanted to achieve with the illegal tariffs.
So in the meantime, what else should the EU do? My colleague was just sharing how the Spanish Prime Minister is advocating for a different relationship between the EU and China. The European Parliament has raised a lot of concerns about the EU's links to China. So what is your position in terms of perhaps seeing Brussels seeking a closer relationship to Beijing?
First of all, we want to negotiate with the United States. Once again, I'm going in 2 hours to Washington so that we have a possibility to have direct contact. We can discuss about reduction of tariffs, buying more U.S. goods, certification recognition, a lot of elements where we can find some common ground. And secondly, yes, we are looking to have a more broad coalition, not only with China, but also with a lot of other countries like India, like Indonesia, Vietnam, which are really harmed by the U.S. tariffs, so that we can stabilize the rule-based trading organization and the WTO as well. So we need really an open and fair partnership with a lot of countries worldwide, and we are working on that.
You brought up the WTO. I want to come to that anyway. What is the future of the institution? Isn't it dead in the water at this point? The biggest trade issues we've faced in decades, and is impotent to do anything.
Yeah, of course, the United States are responsible for around about 15% of global trade. And in the last 20 years, a lot of countries were really well developed, they are self-confident, and I guess we should really try to have a big coalition of the willingness to support a rule-based trading system, and I'm quite convinced that this is possible. Of course, we want to have the United States on board, but at the moment it's really complicated because we are not really seeing that the United States government is respecting international trade rules.
But as you talk about a rules-based system, the reality is that we've seen countries having to put up some barriers at their own border to counteract any market distortions that they could face, any dumping of excess goods. And Europe also has embarked upon that process. How long do you think this needs to continue? And what is the ongoing effect that if these border rules need to remain in place to ward off distortions, that it also has a negative impact on the global economy?
Of course, that's a major risk, and you see that the stakes they're going down, and unemployment is coming, and inflation. So President Trump named a day of liberation. I would say day of inflation, because you see all over the world the negative impact on that, and we need sustainable growth. That's really the main task for Europe, but I guess for a lot of countries as well. And therefore, we should really avoid any escalation. Let's really try to negotiate. That's a proper way to stimulate sustainable growth.
But avoiding escalation would mean not responding to the tariffs, and we have the member states about to vote on retaliation measures. So my question to you actually is related to what you expect to see from Giorgia Meloni when she goes to Washington, D.C. as well. What are you expecting, and what sort of role do you think Italy can play in the EU-US trade tariff spat?
First, we want really to make clear, even we are setting now retaliation tariffs on as a reaction on the illegal tariffs on steel and aluminium. We want to negotiate and find a solution. Secondly, I guess it's totally clear that there are a lot of elements of common interest, and we should really look on that. And thirdly, we want to really have a sense what is the goal, what President Trump wants to achieve. Is it really only the investment going to the United States? Is it the reduction of tariffs? Even we are knowing that the tariffs between European Union and US are quite low, 5%. And related to the volume of products, it's only 2% because 70% of our trade is tariff-free. Or is it really buying more US goods? What is it? So three elements of the mission of Madame Meloni and for myself as well with some colleagues during this week in Washington.
But a lot of commentators have been talking about this being a whole new world, a brand new trading environment. In that context, the dollar has been hit. Even today, euro is looking like a safe haven versus the US dollar. Do you think President Trump with his trade war has damaged the appeal of the US dollar as a reserve currency?
Yeah, because I spoke also to some companies in Europe. Of course, there is an attractive investment climate in the United States, but relating to the instability of the dollar and the instability of policy in general, so they are not so motivated to invest in the United States, and that's really a risk. And as you know, the euro is more and more getting the second choice in the global monetary market.
And Bernd, you are a German lawmaker in the European Parliament, so I would like to understand whether you also have a comment on reports that the German coalition deal could be announced later today. And more broadly, what can actually Germany do in this context of trade tariffs with the United States, given how export heavy the German economy also is?
It's no secret that, of course, we, as Germany, exporting a lot to the United States, and 57% of our exports are based on three product lines. It's cars, it's machinery, and it's pharmaceutical. And of course, this 20% and the 25% on cars are really harm the export of Germany, and therefore also from Germany. And I guess this will be also one result of the coalition agreement which will be announced today is that we should really sit together and negotiate. There are a lot of elements where negotiations are possible. I spent a lot of my lifetime in the so-called TTIP negotiation, and of course there are some landing zones. Let's go ahead and not trying to escalate.
Bernd, thank you so much for joining us today. We do appreciate your time. Bernd Lange with us, the chairman of the Committee on International Trade at European Parliament. We have more lines crossing this morning on this trade war. This is from the French Industry Minister Ferracci saying they're analysing the likely impact of the hit to jobs from Trump's tariffs and to sectors such as aerospace and luxury goods, going on to say that they've reaffirmed Europe needs a firm and proportionate response to Trump's tariffs and Europe needs to show a united front. Coming up on the show, negotiators reportedly aim to reach a coalition deal in Germany by lunchtime. We'll get you up to speed on the talks after the break.
CNBC. Live ambitiously.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
I've always had an ambition to do something I loved. I actually got my degree in hotel and restaurant management, but I had a thing for numbers, and that's how I got onto Wall Street. I became a trader. I traded all different kinds of asset classes. The energy in a newsroom when there's a big news day out there feels a lot like the energy on a trading desk on Wall Street. There's a lot of activity. The stuff we do at CNBC means so much to so many people because it empowers you with knowledge and with everything that you need to make the right decisions.
Inside the world's most cutting-edge technologies.
We're seeing a real opportunity for those with brilliant ideas to accelerate towards change.
Discover the secrets and turn innovative ideas into profitable ventures.
Our vision is a world where human prosperity and economic growth are planet positive.
Embrace digital disruption.
I mean, this is life-changing technology.
CNBC Tech, The Edge, only on CNBC.
Frank Holland, Worldwide Exchange, CNBC.
Welcome back to Squawk Box. Now, onto the crypto world. Ripple announced it will buy multi-asset prime broker Hidden Road in a deal worth $1.25 billion. The acquisition is expected to close in the coming months. Hidden Road has more than 300 institutional clients and clears nearly $3 trillion annually. Now, the impact of Trump's tariffs on the sector will no doubt be a key topic as well at the Paris Blockchain Week, which is where Arjun is joining us from this morning. Arjun.
Good morning, Sylvia. And certainly those tariffs, which have caused markets to go haywire in the crypto world, are in focus. But there's also a focus on Trump's crypto-specific policies. Remember, during his campaign, he campaigned on a pro-crypto message, promised the industry a lot of changes in terms of regulation, in terms of a more favorable environment in the U.S. as well. And there was a lot of excitement going into it about what might happen when he became president. 3 months in, we've seen a couple of things. We've seen the setting up of the Crypto Strategic Reserve and the digital asset stockpile, which is effectively Bitcoin and other digital assets the government has seized in civil or criminal forfeitures that they're holding now. But there was some thought that perhaps the U.S. government might be buying more crypto as part of these reserves. That's not happened as of yet. So there was a little bit of disappointment in the market after that was announced. Has the market so far been underwhelmed? Has the industry been underwhelmed by the Trump administration in its first 3 months? I've been recording a new series here of Beyond the Valley at Paris Blockchain Week. One of my guests, Charles Hoskinson, the founder of IOHK, and Cardano, weighed in on Trump's administration and his crypto policies so far. Let's listen in.
The industry's healing. And it was horrible under the Biden administration. So I appreciate that some people are underwhelmed. I think that comes from sour grapes because they expected a bull run. But it's not going to happen right now. There's too much stuff going on. There's too much uncertainty going on. There's still a war in Ukraine. There's still a war in the Middle East. There's a lot of fear over trade. There's great powers conflict. Crypto's not immune to the macro. And we have to get through all of that macro, and we have to kind of figure that stuff out. So after we get about 6 months in, 12 months in, we'll start getting some more stability.
Charles, there was a time when this strategic reserve was being discussed where ADA and other cryptocurrencies were named as potentially being part of this reserve. That didn't materialize. How did that conversation come about?
I have no idea. I woke up on Sunday. I had 150 messages in my phone, and they say, "Congratulations, you must be the Trump whisperer." I say, "Oh God, what did I do?" And they said, "ADA's in the reserve." I said, "What?" If anybody asked me, I would have said Bitcoin is probably the way to start. You need to create a rule system for inclusion and exclusion for this. But I wouldn't say ADA's been discounted or removed. It's just the government holds more than 100 cryptocurrencies through civil asset forfeiture. And so the first step is to say, okay, the things the government already holds, just don't sell that. And then a broader question is, how should the government interface with the market to buy it? I think probably what they should do is purchase through indexes like Coinbase 50 or these types of things, because then you already have kind of everything figured out. You have the balancing figured out, and it just becomes a strategic asset that you purchase and hold.
The industry is watching for further changes in policy. There's currently a bill around stable coins making its way through the legislative process in the US, and that could be a big deal for the industry if that gets passed as well. But for now, really, the focus still on the turmoil in the markets. We're seeing Bitcoin sitting just above $76,000, well off its all-time high of more than 100,000 hit a few months ago, and billions have been wiped off the market cap of the crypto industry over the last few days. I caught up with Monica Long, the president of Ripple, to get her take on the markets. Let's listen in.
Certainly, the macro environment has become very volatile, like you're explaining, and uncertain. And so I think we at Ripple, we in the industry, we are kind of watching to see what happens, how this plays out. Within crypto, I can say that, within the microcosm of crypto, there's been a lot of market volatility since the beginning. So high times, low times, long low times, the winters as we call them in crypto. And the technology is here to stay. And so especially at Ripple, we really take the long view of build. If we build things that solve problems and there's real utility behind it, then, everything else kind of sorts itself out.
Yeah. Are there any risks at the moment that you see that may spark another crypto winter, or do you think the industry is on a lot more solid footing than it was when we saw the sort of last downturn?
Yeah, it's a good question. Crypto certainly exists within the macroeconomy, so it's I don't think it's it will be a part of the bigger picture. However that pans out, we're going to see. But in terms of any specific risks to the crypto ecosystem, we're in a sturdier place. If I think about the triple S crisis, the crisis from a couple years ago with the banks. Signature and Silvergate Bank kind of debanking crypto, that was a real systemic risk. It was very fragile.
So I think just to sum up, it feels like from those conversations, the industry feels it's in a better place to weather this storm versus a few years ago when we saw multiple collapses and issues in the industry as well. There appears to still be support for Trump and his policies, and a lot of the industry has cited things like the SEC dropping a number of lawsuits against crypto firms across the board as evidence of a more favorable environment for the industry in the US going forward here. And I think a lot of executives are expecting more regulatory clarity to come out in the US over the coming months, and the feeling is that there will be a broad support for the industry. So just a shameless plug before I throw it back to you. Those recordings were part of a relaunch of my Beyond the Valley podcast, which will be launching in video format, and of course keep an eye out for those over the coming weeks, and you can listen to them also wherever you get your podcasts. For now, Sylvia and Karen, back to you.
Well, we were certainly wishing we were listening to it in Paris today. It looks glorious behind you, Arjun. Thank you very much. Meantime, German coalition talks have reportedly been paused after 13 hours of negotiations. That's according to German public broadcaster Tagesschau. Let's get out to Annette for more. Annette, there is so much noise around tariffs, it is hard to focus on any domestic news, but just give us a sense as to what's playing out, because this really goes to the heart of the strength of Europe here and any fight-back strategy that the Europeans may have.
Yes, exactly. The positive news, it's the final stretch. And to actually add the Trump dimension to it, they have done them a favor in the United States because, of course, the whole tariff situation is such a problem, a challenge for the German economy, that actually they moved a lot faster than expected, the two parties. So the sticking points are still the taxes. While the Social Democrats insist on higher taxes for the wealthy, the CDU, of course, doesn't want that. It could be that they could agree on actually getting rid of the solidarity surcharge, which is in place since the reunification days. It was actually installed to shoulder the cost of merging the two countries, so it should get scrapped anyway. So that could be a compromise. And then, of course, they are still struggling to get a deal done on pension and the level of pensions, while the Social Democrats want to have a very firm understanding of 48% of promised pensions. These Christian Democrats are saying we're not going there because this would mean much higher costs for employees and also for employers. So what is expected that they come to an agreement around lunchtime, because both parties have already sent out the invites for their boards to meet today at 1800 in Berlin. And what could happen then next is that, of course, they have an official agreement on the coalition contract, and then the Social Democrats need to vote on it, all the members of the party, and this could then take 10 days. And the final day when Friedrich Merz could be voted in as Chancellor is May 7.
Annette, thank you for the update. Let's see what will happen in Germany later today. Meantime, as we approach the end of this hour of the show, let me show you how European futures are shaping up. They point to more selling on European bourses, erasing some of the gains that we witnessed yesterday. We'll have more after this break.
$1,500 movie? I don't want this flight to end.
Watch the markets open. Brought to you by Emirates.
The ultimate pre-market morning news show. Squawk Box, CNBC.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
One partnership is bringing technology and modern farming together to advance agriculture and feed a nation.
We are starting with an automation platform. So a system which is controlling relevant machines, processes.
This is our prototype for
the precision nutrient injector that interfaces with the Siemens platform that we're building. We're able to store over 100 different types of recipes, and on demand, the machine will actually mix it up and then deliver it to any Go bids.
It is in the same moment giving remotely access to Artisan Green at any point of time. They can see what is the status, what is their energy consumption, what is their water consumption.
The Energy Manager module from Siemens allows us to monitor the equipment, and with that we're able to make sure that the equipment's running at its 100% efficacy, and as a result, electricity costs that way.
Sponsored by
Welcome to Squawk Box. It's 8 a.m. here in London, 9 a.m. CET, and stock markets across Europe are opening up for trade. Another brutal sell-off anticipated according to futures. We went back up yesterday. We had the bounce, but another sell-off anticipated today after that roller coaster ride stateside. We went on gains as investors got back into the stock market as there was a glimmer of hope when Trump said that China wants a deal. The market then selling off, and the reality is today those tariffs have come into force. 104% tariff against China across in other countries. Sweeping is what we see in terms of those tariffs coming into force. So the market today is reacting, and it's a negative reaction, as you can see. Straight out of the gates, we're down more than 2%. So that is a fairly strong move to the downside for the Stoxx Europe 600. Yesterday, we're up 2.7% as we rounded out the day. And we did break a four-day losing streak, so it did take a while to snap the losing streak. But as you can see today, that bounce seems to be premature as we're giving back that territory. The big movers at a sector level, and again, we're talking about whether we've got more sector tariffs coming, this time on pharmaceuticals. So this morning, the sectors where you're seeing as the better performing sectors, they are still in the red and down by 1% plus. So insurance, food and beverage, chemicals, these are the best of the bunch, and you can see down 1 to 1.3%. Autos, telecoms also towards the top of the boards, but that is a weaker start all round. Let's take a look at the bottom end of these are the best performers, how are the worst performers faring. And you can see it is basic resources, the old cyclical trade, that if we are talking about some sort of a sweeping tariff, reciprocal, that are not really reciprocal tariffs that have stepped up today, that impacts the demand for resources. Oil, of course, spot prices have been smashed. So you can see we're down almost 4% on that trade. Banks too, travel and leisure, technology in the round, all down 2 to 3%. The starting point as a result for the European bourses today, the FTSE is down close to 2.5%, and it is just hugging the 7,700 mark, still above that level, but let's see whether that holds. The Xetra DAX always slow to open up, so we're not going to get a signal there just yet, but yesterday it was up 2.5%. Expect that to be given back this morning. French stocks down 2.9%. It was up 2.5% yesterday, so giving back all of those gains plus some territory, and Italian stocks down a very similar amount to what they gained yesterday. So we are seeing another reset in terms of the start here. In terms of the other indices across Europe, let's just take a quick look at the starting point. The SMI, Swiss stocks down 1.8%, the IBEX down 1.9%, AEX shedding 2.7%, and the PSI down 2%. But I think for me, the DAX is one we're watching closely, Sylvia, to see whether it wipes out, again, all of the year-to-date gains for 2025.
So let's dive deeper into some of the sectorial performances here, starting with what's happening in the auto space at this stage. We are seeing a lot of pressure for some of the German car makers. Volkswagen down about 1.8% at this stage. Mercedes down more than 2%. BMW, we are down 3%. I just want to take a moment and remind our viewers of what is happening at this stage, because there's a lot of conversations around tariffs. I just want to put everything into context. We had the United States imposing tariffs on European steel and aluminium. The Europeans are today voting on retaliatory measures off the back of that first move from the United States. But then today we are looking at at new tariffs coming from the United States. These are now into effect, applying a 20% rate on European goods. So I also want to take you to other sectors, looking at the defense names at the stage. We know there has been a lot of momentum for European defense names, no doubt. Of course, first and foremost, with more spending from European governments on defense. And at this stage, looking at some of the performances, we are seeing pressure for Leonardo. We're down 1.3%. Dassault Aviation is also tracking lower, but a little bit of green for BAE Systems and Rheinmetall. In terms of the banking sector, this has the energy stocks, I should say. Thinking about energy, it is a point that is worth discussing at this stage, because ultimately what we are looking at is the Europeans prepare retaliation measure, but what they would like is a deal with the United States. And there's growing comments that ultimately what we could see is an agreement in terms of energy. So let me take you to some of those European energy stocks. We are seeing Shell down 3% at this stage, even more heavier selling for BP. We're down more than 4% too. But I want to take it to banking, because that has been another important sector amid this trade story. There has been pressure in recent days for European banking names in particular. Today, as this new round of tariffs is coming into effect, we have Commerzbank shares down 2%. More selling for Deutsche Bank. We are down 3.4%. And Barclays also lower, almost 4%. In terms of the luxury names, this is another sector worth monitoring amid these trade tensions. It is a very important sector, of particular for the French economy. And earlier comments from the MEDEF, the Business Association in France, highlighting how they are concerned about these tariffs. LVMH at this stage down 3.5%. Kering down more than 4%. So all of this is important to keep in mind as indeed we start this new trading day in Europe, after President Trump said that he will be expanding the impact of his tariff policies, with the pharma sector next in the crosshairs after being exempted from the so-called reciprocal tariffs in place from today. So taking a look at the pharma sector, we are down, in terms of GSK, we're down 2.6%. AstraZeneca down 4%, and there has been a lot of pressure for Novo Nordisk too. This is actually the US listing, so we're not trading there at the stage, but Novartis down also about 3%.
Sylvia, I want to take a quick look at the DAX, and don't forget, as we see the trade today, we've now slipped again, so we're down year to date. The 2025 highs were well and truly off them. This has been the trade today as we open up down to the tune of more than 2%, 2.4 in the red, and so far for the 1 year we're down close to 10%. For the trading week, down more than 11%. So it has been brutal, even as we talk about Europe coming up with its own game plan to ward off the tariff threat. We are seeing stocks globally caught up in the ruts. Ed Smith with us, the co-CIO, Rathbones Investment Management. Ed, we've heard a lot in recent days about rebalancing portfolios, reconstructing portfolios. The dip buyers are not being rewarded at this stage. In fact, they've been punished, if anything. What do you do at this stage?
Well, we're not buyers of the dip yet. You mentioned the DAX and the European rotation. Before Liberation Day, we were rotating more towards Europe. I don't think we've been overweight Europe for about a decade, and we were rotating there. But fully in the knowledge that if the Liberation Day tariffs were extreme, and they obviously were extreme, more extreme than we were forecasting, that European stocks aren't immune. They looked like they were going to get off a bit lightly, and then they caught down over the last few trading days. Europe is a more cyclical market. It has more of its earnings derived from manufacturing, which is obviously caught in the crosshairs of these tariffs all around the world. But Europe does have a few things in its favour, right? It's relatively cheap. Discounts to the US are very large. It's also very under-owned. In the US, foreign investors' holdings of US equities have risen to all-time highs, doubled over the last dozen years. US domestic ownership of equities, the percentage of household wealth in US equities is now all-time highs. in Europe, it's the complete opposite. So there is that sort of floor underneath European markets that isn't there in the US. So in time, we think the European rotation will continue, especially as one of the things that made the US market exceptional over the last few years was this huge fiscal stimulus which works its way into stock markets. Now Europe is joining that a bit. But in the short term, Europe is not immune to this tariff sell-off.
If you bought this year, if you'd done the rotation into European stocks, you'd still be down and down heavily in some of these areas because Europe has become the momentum name. And to me, what jumped out was that you went from a market where nobody could say a nice word about Europe last year to everybody wanting to reposition around European trades, from industrial to banks to defence. At this point, as you've seen stocks come off a lot, what do you think is a golden opportunity in Europe at this point? What would you be looking at?
I mean, look, we're across the board, whether it's Europe or elsewhere, we are selectively looking to add to names. What we want to see, we're a big believer in momentum, right? So stocks that have sold off but have still got positive 12-month momentum, which is one of the best indicators of a momentum-based trading strategy, we like the look of, especially if that's coupled with sector-leading return on invested capital. That quality trade, again, persists across a lot of markets, particularly tough ones, and where you're not paying an egregious free cash flow-based valuation multiples. So one of the things that actually hasn't sold off very much but fits the bill there is Euronext, the exchange, for example. Exchanges tend to do all right during market volatility because actually trading volumes go up, but actually there's that fits the bill in terms of quality. It's still got 12-month momentum. We are still cautious on cyclical names. There are some of the technology companies, ASML, for example, that we are continuing to look at. A fantastically run company, but valuations got too high and it's getting caught up in that sell-off. That is something that we may look to add to in the coming weeks. We're not there yet.
I would also like to get your thoughts on pharma. This now seems to be the next theme of tariffs from Donald Trump. What are your thoughts in terms of European pharma names? Any names that could actually be immune to some extent to some of these trade pressures?
On a case-by-case basis, I don't think there's anyone that's completely immune. There are companies that sell a little less to the US and a little more to elsewhere relative to each other. But there is as we see in these types of environments, very few stocks are ever immune when there is something that targets a whole sector, right? People put on portfolio trades, people trade through ETFs. There tends to be often, at least at first, a sort of indiscriminatory attitude to selling off a sector that's hurt. In time, those stocks which have relatively lower US sales as a percentage of total sales will do better, and those that have strong return on invested capital will lead the market. But I wouldn't rely on that for any immunity in the short term.
I'd also like to get your thoughts more broadly on the outperformance for European stocks. You've highlighted how there's still a few parts of the market that are still interesting at this stage. But my question is around whether volatility is going to be the main item when thinking about European stock performance for the rest of the year, or whether do you think there's actually that we're going to be ending the year still talking about European outperformance versus US markets?
I mean, that's a very good question. I think, yes, we are, but it probably won't feel like that for a good few months. The caveat to that answer, though, is that view is predicated on the world not falling into recession. So we raised our odds last Thursday morning to 45% chance of a US recession, which took our global recession odds to 45% as well. If that's right, so there's a slightly greater chance of no recession. If that holds, then we think markets will recover, and a cyclical market like Europe, given all the structural things that we touched on earlier, will help it lead, and the rotation will continue. If there is a recession, though, it's not so straightforward. European earnings are much more cyclically geared The European earnings are much more sensitive to global leading economic indicators, much stronger correlations there. It's hard for Europe to outperform.
Which takes us to the race for quality, and I want to go to LVMH stock because the moves we're seeing are just extraordinary. Don't forget, this is one of the granolas, one of the stocks that a lot of people hold in their portfolios in Europe, but even before they were looking at buying more of Europe. Before it was the Make Europe Great Again. These were still a couple of great stocks in Europe. The trade today, as we see it fall another 3.3%, has taken us right back to 2021 levels. So as we go back to the conversation, if you liked it at the highs in 2023, you liked it at the highs in 2024, you liked it at the recovery trade in 2025, it's well down on those levels. Do you like it even more today? I mean, when do we start having that conversation about stocks we bought at a higher level? Do we like them more at a lower level today?
Yeah, I mean, we've got to have that conversation. We've been circumspect on luxury for a while. I think a lot of luxury analysts, a lot of people buying luxury just weren't talking to their macro colleagues, or at least perhaps were talking to macro colleagues who were over-optimistic, and I'm talking about China. So the China trade embedded in these stocks just got completely disconnected from our view of the fundamentals. China, even before all of this headwind from trade, was undergoing an absolutely profound property and debt-driven disinflationary slump. That plays out for a long, long time. There is no quick fix. Multiple rounds of Chinese stimulus have not done much to turn things around for good reason. It's a balance sheet recession. A lot of monetary stimulus is pushing on a string, et cetera, et cetera. So a lot of that wasn't captured by the luxury goods companies' prices in Europe. So part of that sort of multi-stage new low formation wasn't about that. And now, of course, you've got to figure out the new world trading regime. Now, some luxury companies...
Just to that point, I mean, what is the store of value of a handbag or any of these luxury goods anymore in an environment like this where people are even concerned about holding treasuries? I mean, what do you do with the luxury basket now, because it feels as though the macro, as you say, 45% chance of a recession? Where does that leave luxury? There are no more places to hide.
Well, right? and luxury is a broad sector, right? There is luxury that is genuinely luxury, as in stuff that is pretty much unobtainable, that only very, very rich people buy. Or there is the end of luxury that actually quite a broad base of the middle class buy as a treat, for a birthday and that sort of thing. For the really upper end of luxury, companies that sell goods in very low lot sizes at very high prices, they may be relatively immune to tariffs, because if they're only selling to very wealthy people, and a lot of this consumption is conspicuous consumption, people want to be seen wearing that watch or driving that car, then they're probably going to pay an extra 20%. So I think that you will see a bifurcation within the luxury sector, certainly when this all settles down, between the really high-end luxury and the more mass market luxury, if that's not a contradiction in terms.
Important discussion is as we talk about safe harbors in this type of market.
And we've been discussing a lot what's happening in the equity space. Let me just share with you comments from ECB's Escriva. We're just getting those in the wires at the stage. U.S. tariffs will have an impact on economic activity in Spain and other countries. For now, I would not talk about the recession. This going back to the points around whether we could see a global recession, this in the context of the Eurozone. However, the same ECB official saying one of the consequences of tariffs could be impact on business confidence and spending, and that will be more difficult to measure going forward. The Bank of Spain will have to revise downwards their projections for growth in Spain. So a quick reaction at this stage from Escrivas, the ECB official from Spain, also highlighting that any forecast at this stage is coming with a high degree of uncertainty. So we are already looking at a reaction from an ECB official at this stage as these new tariffs are now into effect, effectively putting a 20% tariff on European goods. And as I highlighted earlier, we have been discussing with what's happening in the equity space. Coming up on the show, we'll be looking at the bond market as a sell-off in long-dated U.S. Treasuries continues this morning. We'll take a closer look at the bond market after this break.
CNBC live ambitiously.
Social media is the great tool for promoting yourself. So we have to look about, the different rates of people using social media. For older people, we have to go to Facebook. For younger people, we are really focusing on influencers. In every single event that we have in Andalusia, many concerts, we are trying to take an influencer.
Well, I think social media is allowing us destinations, and especially Spain, to showcase who we really are and what do we do. And social media content creators, our collaborators, they are all about what is Spain about and how can you interact with the people of Spain, because we are truly convinced that we live happy lives and we want people to share our happy moments in Spain with us.
A CNBC original exploring equality.
My quote since the beginning was, don't change yourself, change the game.
If you want to be more innovative, more creative, come up with alternative ideas to solving problems, you've got to be more diverse.
And LGBTQ rights and our acceptance are on the line all over the world.
We have something to bring to the table for the solution that we can find together in this fragmented world. And music is always at the center of it.
Real lives, real stories, only on CNBC.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
The ultimate pre-market morning news show, Squawk Box, CNBC.
President Trump's so-called reciprocal tariffs are in effect, and the US president says he stands by his decision to implement levies on America's trading partners. Speaking last night, Trump said he's now focused on closing fair deals.
The war with the world, which is not a war at all, because they're all coming here. Japan is coming here as we speak. They're in a plane flying, lots of them, all tough negotiators. But things that people wouldn't have given us 2 years ago, wouldn't have even thought of it 2 years ago, 3 years ago, 5 years ago, 7, they're giving us everything. They don't want tariffs on themselves. And it's very simple. We're making deals and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%. Now, it sounds ridiculous, but they charged us for many items 100%, 125%. Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger, stronger than it ever was. And 26 Republicans will fight for every state, every seat, and every single vote. We're going to fight like hell.
Is it just me, or is there a big difference between fair and ripping someone off? So which one is it? Fair, reciprocal, or is it now ripping off other countries?
I'm starting to lose track of the definition for certain words here. Even reciprocal. Where is it coming from?
Yeah. Trade deficit reciprocal. Well, Trump's Treasury Secretary Scott Bessent joined him in doubling down.
It was a big mistake, this Chinese escalation, because they're playing with a pair of twos. We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
Meanwhile, China's top leaders will reportedly hold talks as soon as today to discuss measures to boost the domestic economy and stabilize markets after Trump's tariffs came into effect. That's according to Reuters, which cited sources familiar with the matter. Meanwhile, U.S. officials said allies, including Japan and South Korea, will be given priority in trade talks. South Korea's trade minister is traveling to the U.S. after a call between President Trump and South Korea's acting president, Han Duck-soo, with Trump saying he's optimistic a deal can be reached covering trade and payments for the U.S. military presence in the country. Japanese negotiators are also looking to begin talks with the U.S. administration in the coming days, with President Trump saying he would seek tailored deals.
Let's take a quick look at how treasuries are performing this morning. The 10-year, we're now travelling at 4.36%. We've certainly stepped up. A lot of reports of hedge funds selling that has driven up that yield, and the movement very strong in a short period of time. Friday's close, we were travelling at 3.99%. So you can see the escalation to today's rate. So let's come back to the conversation with Ed Smith, the co-CEO at Rathbones Investment Management. And the reciprocal tariffs we've been debating, the view is, even from trade experts, that they're absolutely baffled as to how Trump came up with that tariff board. Even those who were cited behind the methodology for the percentages, they just do not know how Trump came up with those numbers. And this seems to have now spiraled over to bond markets, where there is a view, and this was from Goldman Sachs, about the negative trends in U.S. governance, and institutions are eroding the appeal of U.S. assets for foreign investors. Do you think we're getting to a point of strain on U.S. treasuries?
I think we are, and we, as a house, last year made a very, very large strategic decision, and that was, we have lived through the golden age of multi-asset investing, where the 10-year treasury bond was just a great diversifier for equity risk, and that has now changed. That changed. We thought that changed last year, and even before this, for a variety of different reasons. Some about the politics and geopolitics, some about fiscal, some about just the stability of inflation in the new world. So we now, in our bond exposure, in our multi-asset portfolios in Rathbones Investment Management, have taken back the duration right to the bone. Very short duration assets. Our modelling suggests that that is a much more prudent strategy. Now, what we have seen in recent days is sort of reasons to reaffirm why that was quite a good idea. Yes, there have been a few days where equity markets have gone down, bonds have gone up, but there's been a lot of days where that has changed. We think that the market was wrong to start to discount 5 rate cuts from the Fed this year. Maybe we'll get that sort of further out, but the timing's off, right? Inflation comes through first before growth slumps. The current situation is that the labour market is still relatively strong. We're going to get rising inflation. Even if the Fed does cut rates, whilst inflation is going to 5%, that's going to cause inflation uncertainty at the long end of the bond curve. It's going to cause the term premium to go up. It's not a great situation. And then you've got the prospect of all these tariff revenues being recycled or recycled and some into fiscal stimulus at a time when markets are already questioning the US deficit, and that further destabilizes the term premium on treasuries.
The scenario you point to on rates is very similar to what Mohamed El-Erian was telling Sylvie the other day in Italy about the way markets are priced this perhaps incorrectly around rate cuts. But I want to get to the weaponization of treasuries, because the Japanese are saying they won't go there, they won't do that. But the Chinese are a different scenario here. Do you think they could weaponize US treasuries?
I'm not sure it's in their interest to flood the market with their treasury holdings. That would cause a lot of financial instability at a time when the country is already pretty financially unstable for the reasons we touched on earlier. It's got this absolutely enormous property debt-driven deflationary bust going on. Plus, China wants to be seen as in time it wants that sort of global economic hegemon status, at least for the Eastern Hemisphere. It's not going to want to do things that massively destabilize its capital account. But yeah, I mean, if you were a Chinese treasury manager, and certainly if you were a sovereign wealth fund manager in China, you're going to be stepping up the effort to diversify away. China's been doing that for a little while, but it still has very large holdings, and making a huge splash dumping them is pretty destabilizing for important official reserves.
Let me bring it back to Europe, and perhaps we can show how European bond yields are moving this morning. Overall, the story is we're seeing a spike also in European bond yields. You said that you were very short in duration for treasuries. What about the positioning for European yields?
Yeah, so we did add a little bit to our gilt duration last week, and gilt yields, well, they didn't have the sort of few days of them tracking down like Treasury yields did, so they haven't, and thankfully they haven't bounced too much this morning, at least when I was looking before I was coming on the show. There is a lot of co-movement in global bond markets. Banks view G7 sovereign bonds as sort of reasonably perfect substitute for each other, so that's why there is that strong correlation between treasuries and what the rest of the world does. But yeah, the wedge between the yields, whilst tethered, it does fluctuate a little bit. So we do expect to see some upward pressure continue on European yields if treasuries continue to track higher meaningfully, but it will be of a smaller magnitude, most likely.
Ed, thank you very much for joining Sylvia and myself. Ed Smith with us, co-CIO Rathbones Investment Management. Ahead on the show as Trump tariffs hit markets, we'll take a look at what it may mean for M&A this year.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. My ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
This is a good global debate.
There is no place in the world where we get the kind of access to so many amazing interviews.
To be able to solve problems at a scale that nobody's ever imagined. This industry is going through its renaissance.
How big a game changer is this?
Let's go.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fell for them.
I believe in getting justice.
American Greed on CNBC.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Welcome to Squawk Box. I'm Karen Cho with Sylvia O'Mara, and these are your headlines. European equities plunge as sweeping new tariffs take effect, with the EU facing an additional 20% levy and the minimum Chinese rate now standing at an eye-watering 104%. Trump, though, says the US is stronger than ever.
Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
Healthcare names lead the declines as Trump signals the sector will be next in the crosshairs after being exempted from today's new levies. The sell-off spreads to bond markets as long-dated yields surge. The 30-year US Treasury yield spikes to its highest level in over a year. And Europe follows suit, with the UK's 30-year yield touching a 28-year high. Our US futures reverse course. The Dow and Nasdaq now see narrowly higher after tariff speculation drove whipsaw trade on Tuesday.
I want to take you to what's happening in equity moves this morning. European equities have been trading for just over 30 minutes time, and we are back in negative territory. Let me run you through some of the moves. We have the benchmark, the Stoxx 600, down almost 2.8% at this stage. It's important to keep in mind that yesterday we had witnessed a rebound in European equities with the benchmark gaining about 2.7%. That at this stage has been erased with pressure on all of the major bourses in Europe. Thinking about the sectorial moves, let me show you the top performing sectors at this stage. And even there, you see red across the board. Media stocks is down 1.3%, but it is food and beverage as well as chemicals that are the worst performing, that seem to be the worst performing sectors in what is the best performing sectors at this stage. I actually want to take you to the worst performing sectors so we get a better picture of what's happening here. Again, healthcare down 4.6%. It's important to keep in mind that the president, Donald Trump, has made the comment that pharma is likely to be the next sector impacted by U.S. tariffs. So far, they had been exempted, but now the president seems to suggest that that could be the next point, the next target in terms of tariffs from the United States. Oil and gas also down 3.4%. We also have seen a lot of pressure on oil prices down at this stage too. I want to take you to some developments that we are monitoring today, thinking about tariffs, and now that these new tariffs from the United States are already into effect, European member states will be voting today. But this, however, on the first round of tariffs that the United States has imposed. So what we are witnessing today is the Europeans will be voting on their response to levies on steel and aluminium imports imposed by the United States. The bloc is targeting 26 billion euros worth of U.S. goods, including motorcycles and jeans. Now, if approved, the tariffs would come into effect from mid-April. In addition to the proposed tariffs, EU officials have reiterated that they are hoping for open negotiations with the Trump administration.
Elsewhere, German coalition talks have reportedly been paused after 13 hours of negotiations. That's according to German public broadcaster Tagesschau. Let's get out to Annetta for more. Annetta, just walk us through the significance of where we're at in terms of these coalition talks, because some of the reporting around Friedrich Merz has not been that favourable in recent days.
Yes, it is. I think still hard to swallow for loads of Germans that he kind of U-turned on the debt issue, but still overall, I think, at least from the business perspective, it's a net positive that they're moving fast, that also the CDU is sticking to their point, not hiking taxes. So, but let me run you through where we stand. Right as we speak now at 9:30 Berlin time, the talks will resume, and I think they're sort of the timeline is that they come to a compromise and on the sticking points by midday, and then they will meet, the boards of each party will meet around 1800 local time to present that to a broader or a bigger group of leading figures in their respective parties. Then the SPD voters or elected members, I should say, need to vote on the coalition contract, and only after then, on probably May 7, Friedrich Merz will be voted on in Parliament to be the next chancellor, and then we have an intact next government. So it's still a little bit of time until the new government actually really hits the operational ground. But still, the message is clear. They are willing to move fast, and the sticking points are still on the taxes. But there is a compromise inside, and also on the pensions. That might be a little bit of a bitter pill to swallow for the Social Democrats, because the Christian Democrats do not want a fixed level of pensions, because it would mean much higher costs for employers and also employees. So that's where we stand right now. But of course, that whole tariff escalation has also given them a sense of urgency in a way that is helping them as well to come to a compromise, to have an intact government, an operational German government, which is so important at these times, in place by the beginning of May.
Annetta, thank you very much for bringing us an update there live from Germany today.
Now, on to M&A. Flows are likely to be impacted by Trump's tariffs onslaught. That's according to EY Partner, which says the macro picture could reduce the number of deals done with the U.S. and China. So let's discuss that with our next guest, Andrea Garzoni, Global Vice Chair at EY Parthenon. Good morning, Andrea. Great to have you on the show. We started the year with quite a lot of optimism and a lot of positivity, really, expecting a lot more M&A and listings this year. Just walk us through what has been the impact of this market turbulence for the outlook of more M&A for the rest of the year.
Hi, good morning, and thank you for inviting me. Actually, we were observing a real rebound until the end of last quarter. Through March, the activity actually was up 16% in value and 30% in volumes year on year. And so we were really seeing some signs of upticking market, especially in the medium and large size deals. Actually, March was a very good month with more than 450 billion of value of deals. Now, the last 7 days have actually created a lot of uncertainty, an amount of uncertainty that will inevitably impact the appetite for M&A, which was actually, according to our latest CEO survey, growing, was actually at an all-time high before actually the last 7 days. So it's too early to say what's going to be the magnitude of the impact of this tariffs situation. But it's likely that in the near term, in the next couple of weeks, there will be a slowdown and possibly a complete stall in M&A activity due to the high level of uncertainty that is obviously impacting with various ramifications, also the capital flows, not just the trade flows.
And what are companies saying in terms of what would it take for them to take this step in terms of M&A deals?
I think it's important to understand that M&A can actually continue and even thrive in high level of uncertainties. I mean, if you look at what happened in the immediate aftermath of the pandemic, we saw actually the M&A activity surging after a first couple of months of stalling activity due to really the highest, super high level of uncertainty. But once the situation cleared and it was quite obvious that there were certain trends that needed really to be followed, the capitals actually were allocated accordingly and there was a surge in M&A. So now I think what would be required is some sense of directions regarding this tariff situation, whether this is going to last or not, whether this is going to be a negotiation situation where actually in the next 2 or 3 weeks there will be a different scenario. So as soon as the uncertainty goes down and there is more clarity regarding the new world, then the capitals will flow. And I think those who actually, in particular, those CEOs and companies and private equity, which have the highest level of confidence and ability really to navigate this, will try really to prevail.
Andrea, let me bring up the bond story, though, because we're now seeing a big spike in yields on U.S. Treasuries, the safest of safe assets that a lot of assets are priced on. How does that make valuing assets more difficult?
It does. It does for sure. I mean, everything is very complicated now in terms of assessing values and assessing long-term return for every asset. So if you look at whatever kind of valuation models, I mean, considering the number of uncertainties, starting from the top lines of companies going down to operations and taxations, etc., well beyond tariffs, I mean, all those variables become very difficult to predict and to model. So that's why really the volatility will remain very strong in the coming weeks.
Andrea, even if you do expect a bounce back in deal making once we get through the tariff uncertainty, is it fair to say 2025 is not going to be the promised year we had hoped for M&A?
That's a very interesting question. For sure, the next quarter is going to be a very difficult one. I do predict a slowdown, even a stalling situation in M&A activity. really the ramifications coming from the trading flows uncertainties will trickle down and will impact inevitably M&A. But again, it can well be that in the second part of the year, if the situation becomes more normal and predictable, there could be a surge actually in activity. So it's too early to say. I would really stick to the short term. I see a couple of very difficult weeks ahead with very low level of activity and a lot of projects put on hold. The wait and see attitude will prevail, I think, across the board.
Andrea, thank you very much for joining us. Andrea Gazzoni, who is the Global Vice Chair, EY Parthenon. Well, some news elsewhere. NBC Universal has confirmed plans to open its first resort in Europe. The park, which will be located in the UK, less than 40 minutes from London, is expected to open in 2031. The government says it's expected to create around 28,000 jobs and boost the economy by £50 billion. NBC Universal is owned by Comcast, CNBC's parent company, but I don't know if we're going to have any special privileges by 2031.
Even the business plan is right, but a positive story nonetheless. When I read it this morning, I was like, oh, a little something joyful to look at this morning.
To go. We don't have to go across to Disney in Paris anymore. We can
a little bit more local. Now, coming up on the show, we'll be looking at the Bitcoin. The cryptocurrency is sliding as the investors move away from risky assets amid fears of an escalating trade war. We'll be live in Paris at the Blockchain Week after this break.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
On a $100,000 margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. Each trade is even higher. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Learn how to use AI to be more successful with CNBC Make It's new online course.
We'll give you examples that can help you master AI tools.
Go to CNBCMakeIt.com/AI and register now.
Ripple announced it will buy multi-asset prime broker Hidden Road in a deal worth $1.25 billion. The acquisition is expected to close in coming months. Hidden Road has more than 300 institutional clients and clears nearly $3 trillion annually. The impact of Trump's tariffs on the sector will no doubt be felt and a key topic at the Paris Blockchain Week, which is where Arjun joins us from. Arjun, there are so many pieces that are moving on markets. The safest to safe assets are being hit, from treasuries to the dollar. I wonder where that leaves the crypto space, which of course is also under fire, but no doubt some of the crypto enthusiasts would say, look, it suggests that there's room to position around crypto in future.
Yeah, certainly, Karen. I think you've seen the turmoil that's hit other types of asset classes, certainly bearing down on Bitcoin and the broader crypto space. Billions have been wiped off the market in the last few days. Bitcoin's well off its all-time high, which was over $100,000 just a few months ago as well. And some of the appears to be coming out of that Trump-induced rally we saw towards the back end of last year. He campaigned, of course, on a very pro-crypto message, and that was getting the market very excited. So it is about assessing where we're at now and what the industry is feeling. And I managed to catch up with Charles Hoskinson, who's a founder of IOHK and the Cardano blockchain. He was also one of the co-founders of Ethereum. He's been in the industry a long time, and I got his take on what's happening in the state of the markets and where all this tariff drama leaves the crypto industry. Let's listen into what he had to say.
What ends up happening is crypto benefits in the long term, because geopolitically what's happening is we're moving from a rules-based international order to a great powers conflict. Now, we're kind of young, so we spent our entire adult lives under a rules-based international order, but our parents and grandparents, they lived under great powers conflict. It was the United States and the Soviet Union going at it. So it didn't matter what the trade deal was. It didn't matter what the rule law was. If the Soviet Union wanted to do something or the U.S. wanted to do something, they just do it. And now we go back to great powers conflict. If Russia wants to invade Ukraine, it invades Ukraine. If China wants to invade Taiwan, it's going to do that. So treaties don't really work so well, and global business doesn't really work so well there. So your only option for globalization is crypto. If you want to do business with countries the United States doesn't like, or Russia doesn't like, or China doesn't like, in a global commons, you can no longer do that through treaty organizations or legacy banks or things. You can only do that through crypto.
Just to get back to kind of where we currently are, you don't think we're heading towards another crypto winter at all?
No. I think Bitcoin will be over 250,000 by the end of this year or next year.
What's going to drive that, do you think?
What will happen is that the tariff stuff will be a dud, and that people will realize that the world is willing to negotiate. And it's really just U.S. versus China, and a lot of people will side with us, some people side with China. The markets will stabilize a little bit, and they'll get used to the new normal.
Hoskinson's view there really is something that you were sort of alluding to there, Karen, is that there are many in the industry who feel in times of flux in the markets, in times of flux geopolitically, that crypto could be a space to hide and could do very well. It's a narrative we've heard over the years, which I'd say hasn't really borne out as of yet. So it'll be interesting to see if this time is different with all of the tariff drama we've seen around the world. Now, crypto, of course, historically has been very, very volatile. We've seen huge swings in prices, and people in the industry, well, they're quite used to it, I think, at this point. They've seen the downturns and they've seen the upturns. But the question is, are we in a state right now of a prolonged downturn? And that's what we're trying to figure out. And that's a question I discussed with Monica Long, the president of Ripple, here at Paris Blockchain Week. Let's listen in.
Certainly, the macro environment has become very volatile, like you're explaining, and uncertain. And so I think we at Ripple, we in the industry, we are kind of watching to see what happens, how this plays out. Within crypto, I can say that, within the microcosm of crypto, there's been a lot of market volatility since the beginning. So high times, low times, long low times, the winters as we call them in crypto. And the technology is here to stay. And so especially at Ripple, we really take the long view of build. If we build things that solve problems and there's real utility behind it, then, everything else kind of sorts itself out.
Yeah. Are there any risks at the moment that you see that may spark another crypto winter, or do you think the industry is on a lot more solid footing than it was when we saw the sort of last downturn?
Yeah, it's a good question. Crypto certainly exists within the macro economy, so it's I don't think it's it will be a part of the bigger picture. However that pans out, we're going to see. But in terms of any specific risks to the crypto ecosystem, we're in a sturdier place. If I think about the triple S crisis, the crisis from a couple years ago with the banks, Signature and Silvergate Bank kind of debanking crypto, that was a real systemic risk. It was very fragile.
Getting a sense from the conversation, the industry feels it's more resilient than in the past. Crypto could potentially benefit from the turmoil. I think one of the things keeping the industry positive is the fact there is a pro-crypto president in the US, and that's still underpinning some of their bullishness at this point. Doesn't take away from the fact, though, that there is huge uncertainty in the crypto markets, and the industry is certainly feeling that. For now, guys, back to you in London.
Thank you very much for that, Sylvia. On that note, let's pivot to major currencies, because we are seeing some wild moves out there in relation to the dollar, and the central bank out of China now also communicating to the market as we see this yuan depreciation. The communique here is that it will not allow sharp yuan declines. It's asked major state-owned banks to reduce US dollar purchases, according to those with direct knowledge. The directive comes as we've seen that heavy downdraft in the yuan following the tariffs from the United States, the 104%. The Bank of China, the People's Bank of China, has set the window guidance, which is their pretty much informal way of managing a policy around markets and to banks this week. So it's asked state banks to withdraw dollar purchases for proprietary accounts, to strengthen checks executing orders for clients. So again, trying to crack down on some speculation here, will not resort to immediate sharp yuan depreciation. Again, I think they're trying to send a message about stability, because don't forget, it's not just about trade with the United States. I mean, China has a window here to demonstrate to other trading partners that it's a reliable place to do business. So if it has wild swings in its currency, where, let's face it, some of the trade may still be conducted in US dollars versus yuan, then it would be destabilizing. So this communication now, I think what we've heard today, which is fairly interesting from my perspective, is that you've had a number of central banks getting involved in different ways, whether it's around rate cuts, managing currencies, or communicating to the market.
And we continue to see further appreciation for the euro and sterling, particularly the euro. It's up at this stage 0.7% against the US dollar. Let me bring you back to the equity session in Europe. A very important day as this new round of tariffs from the United States is now in place. We are seeing further pressure for European equities this morning. We have the benchmark down 2.4%, so reversing some of the gains we witnessed yesterday. In terms of bond market, let me show you the moves in European bond yields this morning. We are seeing that they are rising across the board. Thinking about the benchmark, the German 10-year yield is higher this morning. In terms of treasuries as well, that continues to be the story stateside too. Briefly taking a look at the 10-year Treasury yield, we are up at 4.35% at this stage.
A quick look at US futures. To me, it's a little bit like when you're looking out the window and there's bright sunshine. You come back the next minute and it's pouring with rain. Come back again and then it's snowing. It's been a bit like that on the US market yesterday. And on futures, as we get set up for trade, a little bit of green on the boards. Will that be whipped away with some other commentary? What sort of market do we have? Because it feels as though having central banks now involved suggests that they are concerned about just how orderly these markets are still going to be from here. But have a good day out there if you can. It is certainly a wild market ride environment. So we'll be back tomorrow with some more numbers and analysis for you. Thank you for joining Sylvia and myself. That's all for Squawk Box. Up next, Street Sounds.
CNBC. Live ambitiously.
Hello, everyone. I'm Julie Sweet. Welcome to another edition of Reinvented with Accenture. Today is a very special episode. Normally, we're talking about reinventing a company. Today, we're talking about reinventing a country.
Payments have to be fast, they have to be secure, they have to be convenient, and they have to be inclusive. Those are things which are not negotiable. And when you think about it, there is no single commercial transactions which doesn't rely on a payment at some point.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart. Okay?
Squawk Box, weekdays.
Leaders from the world of sport talk tech.
You have technology that is now allowing coaches to reduce the risk of injury.
AI gaming is going to be one of the most fundamental disruptions.
And new growth opportunities.
There's an opportunity for us to come together, for players to play across different platforms. I think that's really wonderful.
What do you do while you're watching sports? Not everybody likes the lean back experience. People like to lean forward and engage. Highlights from Converge Live, only on CNBC.
Master
master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward.
The number one soft skill is flexibility,
preparation,
confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
The top fintech companies list is back. CNBC and Statista are looking for the world's standout firms, following in the footsteps of some of the biggest industry players. To find out more and submit your application, head over to cnbc.com. CNBC meets David Beckham.
For a long time, people wanted me to do the life documentary, but I'm not very good at opening up. The things that I've been through in the past, I've kind of put in a box, locked it up, and thought I'm never going to have to talk about it again. And I was happy with that. But I didn't realize how important it was for me to actually talk about this stuff. So I opened up and talked about things that I'd never spoke about before, like, you know, injuries and worries and things that went on throughout my career, you know, the sending off and how that made me feel.
When you talk about the sending off and the reaction to it, when you look back, what kind of mental resilience?
Well, I'm really glad social media wasn't around back then, because it was bad enough then. It was challenging, and when I look back at some of the footage, some of the archive stuff I'd never seen before, and it was hard to watch, and I get emotional talking about it.
Squawk on the Street, CNBC.
Good morning and welcome to Street Signs. I'm Juliana Tattlebaum, and these are your headlines this morning. America implements its harshest tariff regime in over a century, imposing so-called reciprocal levies on dozens of countries, with China subject to a 104% duty. Trump says the U.S. is stronger than ever.
Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
European equity